All right. Good morning, everyone. A warm welcome to all of you for joining us on day one of the Next Gen MA and PEVC Playbook, an advanced executive program designed to decode India's fastest evolving deal making landscape. My name is Sukriti, and I look at the events and training production here at HTVC Circle. It is my privilege to anchor the sessions over the next 2 days and guide you through a carefully curated learning journey. Before we begin, I would like to invite my colleague Mansi Taneja, who leads the Inside Sales team at VC Circle here to deliver the welcome address. Over to you, Mansi.
Thanks, Sukriti. Good morning, everyone. I very warmly welcome you all to the Next Gen M&A and PEVC playbook. Over the next 2 days, we will deep dive into the rapidly evolving world of deal making, billion dollar transactions, new age structuring models, private credit, governance exits, cross border opportunities, and many more insights to take care of from here. Uh, just to give you an overview, Sukriti, can we have the slides, please? Yeah. So continuing, just to give an overview, VC Circle is a fully owned subsidiary of HT Media Group. And before we dive into the sessions, I would just want to walk you through the basic, how HT Media is and they function. So you can see on the slide, we have three brands, Hindustan Times, Mint, and Hindustan. They all are our print medias. Under the mosaic, we have VC Circle, VCC Edge, and Tech Circle. VCC Circle pioneers the news and the digital insights of the events and training. VCC Edge is a data-driven platform, and Tech Circle is, as the name suggests, it's more inclined towards the tech side of it. Across all these brands, we collectively reach over to 200 million people, including the founders, corporates, investors, policymakers, and senior business professionals. Now, I think I would want to express my gratitude for all the delegates and the speakers who are taking out time today. And here I would like to emphasize on that why this program is important. So this masterclass is a culmination of insights gathered from years of tracking India's private market, investment cycles, and structural shifts. And our focus is not only on the technical side of it, but also on the emerging trends and the key practices that are going in the market. And that's what the trainers will also focus on. The agenda overview is that we will talk about India's 2025 deal landscape, structuring innovation, convertibles, earnouts, hybrid debt, gift city, private credit and alternate financing, case studies on the deals, ESG governance and digital playbooks, IPO readiness and secondary transaction, cross-border deal making, US and India and SEA, and lastly, future deal making strategies for the CXOs. Uh, we can go to the trainer slide, Sukriti. Yeah. Our first session will be with Mr. Rachit Chawla. He will be talking about India's M&A PVC outlook, mega deals and sector hotspots. But before we begin the program, I would like Sukriti to take over further. And there are few key announcements that we would want to have before the session starts. Completing the presentation here, the hashtag that we are using today is VCC Next Gen Deal Structuring Training 2025. Please use the hashtag and you can tag us. We can have your feedback over the live streaming as well. Over to you, Sukriti. Welcome, Mr.
Thank you so much,
Chawla,
Mansi.
to start the program.
Thank you. Thank you so much. Okay, so before we begin the session, a quick note for all the participants or the audience who've joined us today that after every session, you will see a quick feedback poll popping up on your screen. It'll take barely 15 seconds for you to share your inputs with us, which will help us improve and also help the speakers tailor their delivery across the program. So that's one. And we strongly encourage you to please ask questions to our speakers and the trainers who are here through the Q&A box. And either you can raise your hands. The sessions are designed to be interactive. Our speakers will be happy to take the questions here. Right? Rajit, welcome to the training. Thank you so much for doing this with us. And you may please go ahead and start.
Thank you, Sukriti, for having me here. Should I share my slides?
Yes, please.
Just 1 second. Right. Is my slide visible?
It is visible, Rachit. You can just put this in the slideshow.
Right.
Looks
So
good.
good morning, everyone. I'm Rachit Chawla. I'm the founder and CEO of Finway Accelerator. And today, during the next 60 minutes, we are going to talk about India's M&A and private equity VC outlook. We're also going to talk about certain mega deals and sector hotspots. So, just setting the context, India's 2025 deal landscape remains resilient amid global headwinds. We are going to also talk about volume versus value trends. Volume versus value trends refers to how the number of transactions compare with the total monetary worth of those transactions, which is the value over a period of time. Then we will talk about some mega deals, which are exceptionally large transactions that exceeded a specific high value threshold, typically above 500 million or USD $1 billion. Sector hotspots are industries or segments experiencing accelerated growth, high investment activity, or strong market momentum. And then we will end my session by talking about India's resilience and outlook. So, this reflects the country's ability to maintain economic stability and growth despite global uncertainties. So, starting our first topic, which is volume versus value trends 2025, let's go through the first half of 2025. So, around $50 billion worth of deals were transacted, which is slightly up 2% versus the second half of 2024, but close to 17% year on year down. So another estimate, if I look at in terms of deal value, is $41.5 billion were transacted as compared to Q2 2025. So again, you see a slight dip year on year there. In terms of deal volume, the first half of 2025, there were 1,285 transactions, which is again down compared to year on year. Another estimate that shows is variance by method and category. If you see Q2 2025, deal count actually increased 23% year on year. So these are the reports by EY and Grant Thornton. The firm EY reports that India's M&A deal value in first half of 2025 stood about $50 billion, but down 17% compared to first half of 2024. Similarly, as mentioned earlier, in the quarter Q2 2025, there was a decline of about 20% year on year in India, as per the report of Grant Thornton. So M&A deals totaled to the value of $7 billion from 69 deals. However, at the same time, PEVC deals totaled $3.6 billion from 120 deals. So banking and financial sector accounted for 44% of total value in October. India's deal landscape in 2025 shows a disconnect as the volume is rising or stabilizing following many smaller and mid-market deals. However, the value is softening on the back of fewer mega transactions. So if you see that the volume or the size of the transaction is still at a higher side, but the number of transactions are declining. The primary activity is driven in by renewable energy, infra, banking, financial services, and a consolidation-led M&A. So if we see that there has been a surge in billion-dollar deals, uh, for example, Emirates NBT acquired 60% of RBL Bank for US $3 billion. So there was shift from smaller add-ons to transformational acquisitions. India experienced a significant surge in economic activity in October 2025. There were certain notable deals like Schneider Electric's SE acquisition of a 35% stake in Schneider Electric India Private Limited for about $6.35 billion in Q3 of 2025. Then there was TMLCV Holdings takeover of Aveco for approx $3.78 billion. our Indian company JSW Paints acquisition of Axo Nobel India, valued at about $1.52 billion. And in H1 2025, there were about 10 plus transactions that exceeded US $1 billion, underlining the fewer but larger deals trend. So there were recent major IPO listings, like Grow listed on November 12, delivering an 84% gain over its issue price. Pine Labs also recorded positive listing gains in mid-November 2025. LG Electronic India had a blockbuster October debut, $1.3 billion IPO worth IPO fully subscribed in just 6+ hours, and the stock surged 48% on the listing day. So there's definitely a strong shift towards domestic participation. Institutional and retail investors are driving IPO demand, reducing dependence on foreign capital. Since early 2024, domestic funds have invested more in IPOs than in foreign funds. Nearly two-thirds of IPO in 2025 are OFS, which is offers for sale, enabling VCPE investors to exit and reinvest rather than companies raising fresh capital. So the large deals account for disappropriate share of total deal value, meaning a smaller number of mega transactions driving much of the value. And what we have witnessed is that there are prominent sectors like manufacturing, automotive, banking, financial services, industrial coatings. These are certain strategic themes. And foreign investments in Indian banks is also something which has been witnessed. So, what are the key drivers behind mega deals? The number one driver seems ample global and domestic dry powder. Second is policy stability, domestic consumption. Third being strategic consolidation across fintech infra and renewables. And the fourth is exit readiness and valuation corrections. So, strategic consolidation, large corporates are acquiring competitors or complementary assets to strengthen their market leadership and accelerate scale. Foreign capital inflow, if we see global investors and sovereign funds, they are increasing exposure to India's long-term growth story, especially in banking, energy, and infrastructure. Then there is energy transition and sustainability push. Renewables, electric mobility, and green hydrogen policy are catalyzing billion-dollar transactions in power and energy storage and clean tech. Digital infra expansion is also another reason. There's a lot of demand for data centers with the AI boom coming in. A lot of data centers have seen a lot of demand across the globe. Telecom capacity, AI infra, cybersecurity, and cloud platforms is driving of platform level acquisitions. Also, there is regulatory stability and policy reform in India. There is a predictable tax framework, PLI schemes, and sector specific incentives are encouraging large ticket commitments. Uh, Private equity exits and secondary deals, basically, there are mature investments and fund lifecycle timelines are also resulting in large secondary buyouts and partial exits at premium valuation. Now we are going to cover the second topic, which is the sector hotspot, renewables. We have personally seen that a lot of green energy M&A surge is there, which basically means solar, wind, and green hydrogen. Almost $1.7 billion worth of deal value has happened in Q3 2025 alone. This is primarily being driven by regulatory push and investor interest with scalability. So India has attracted $11.8 billion in renewable energy investment in the first half of 2025, marking the second highest half year on record. So solar energy itself accounted for the largest share of these investments, which is 77%, in first half of 2025. Foreign direct investment in the renewable sector grew, reaching nearly 8% in 2025, up 1% in 2021. The cumulative renewable energy capacity reached 234 gigawatt as of June 30, 2025. The government's budget for MNRE in the 25-26 fiscal saw a 39% increase over the previous year's allocation. There are certain hotspot sector, which is deep tech and IT, AI, semiconductor, software as service, attracting strong PEVC inflows. Focus area again remains analytics, cybersecurity, enterprise software, and also global firms are on a spree to acquire Indian deep tech capabilities. In 2025, the Indian deep tech and IT sectors have seen substantial activity, with deep tech funding reaching over $1.43 billion by November. Key themes include a surge in early stage investment in AI, semiconductors, and space tech, significant government support through new funds, and a steady stream of M&A and IPOs. The funding in the deep tech sector in 2025 has seen a notable 29.74% rise as compared in the previous year, with a focus on cutting edge technologies like AI, robotics, and quantum computing. There has been a significant funding rounds in the deep tech, which includes QNU Labs' $7 million Series A, Agnikul's $6.7 million Series B. At the same time, the broader IT sector has been consistent activity with a focus on AI, cloud transformation, and platform modernization. Major transactions in the IT sector include Capgemini's acquisition of WNS, Kali's acquisition of Andestra, and Bain Capital's acquisition of HSO. Moving on, the government is actively supporting the deep tech ecosystem through various initiatives. The government launched a 10,000 crore, which is $1.2 billion fund of funds just in April 25 to provide long-term capital for early stage deep tech ventures focusing on AI, quantum computing, robotics, and biotech. The India Deep Tech Alliance, which is IDTA, a public-private initiative with over 15,000 crores in committed capital, was also launched to support strategic national technologies. The National Deep Tech Startup Policy aims to streamline the IP licensing and enhance collaboration between academia and industry, a crucial step given that significant portion of Indian deep tech ventures originate from academic research. Just to summarize, the sector hotspot in financial services, USD 3.1 billion PEVC investment in Q3 of 2025. Main drivers have been digital banking, fintech innovation, and NBFC consolidation. There have been tradition and new age lenders which are merging for scale as well. Like Emirates NBD's acquired RBL Bank in a 60% stake deal, which is the largest overseas investment in the Indian financial sector at 26,331 crores. Then there was a Sumitomo Mitsui Banking Corporation, SMBC, in Yes Bank. SMBC acquired a 20% stake in May for rupees 14,043 crores, followed by an additional 4.99% stake in September. And then there was Blackstone Investment in Federal Bank. The private equity firm invested 6,197 crores for a 9.9% stake. Then there was International Holding Company, which is IHC, in Saman Capital. IHC acquired a 43.5% stake for about $1 billion. Geo Financial Services fundraising secured almost $1,826 million through a provincial issue. If we talk about the broader market trends, there is an increased cross-border M&A. A significant rise in M&A activity was fueled by foreign investors seeking opportunities in India. Strengthening private equity. Private equity saw significant activity with large deals from global players. The focus is continuous as seen in financial inclusion. The government continues to push financial inclusion across India, mainly through schemes like Pradhan Mantri Jeevan Bima Yojana, reaching millions and millions of people. Focus is on AI in banking. RBI introduced the framework for responsible and ethical enablement of artificial intelligence, which is free AI, to govern the ethical use of AI in the sector. And banks focused on integrating AI for efficiency and customer service. Uh, in terms of conclusion, India's 2025 deal landscape is being shaped by distinct sector hotspots with activity concentrated across renewables, financial services, manufacturing, technology, infra, healthcare, and consumer markets. Renewable energy and infra continue to lead in value, driven by consolidation and policy-backed expansion, while financial services remain a magnet for cross-border capital and strategic acquisitions. The technology and data center platforms are witnessing increased deal flow as valuations stabilize and AI-driven growth accelerates. Meanwhile, healthcare, manufacturing, and consumer segments are seeing steady mid-market consolidation as companies pursue scale and integration. Overall, the year reflects a dual pattern: mega transactions anchoring deal value, while a consistent pipeline of mid-sized deals support volume and momentum. Moving on, the deal structures and valuation trends. The growth capital, which is USD $4.1 billion, startup investments, 3.5 billion in Q3 2025. There have been exits across 81 deals, valued at $13.7 billion, which is a 61% year-on-year growth. Structured discipline returning and mega deals continue to dominate. The deal structures in 2025 increasingly reflect a balanced approach to risk sharing, regulatory alignment, and value realization, with a noticeable rise in structured transactions such as earnouts, deferred consideration, and majority stake acquisition over full buyouts. Strategic and cross-border deals are favoring phased ownership models and joint ventures, particularly in capital incentive sectors like renewables, infrastructure, and manufacturing. Valuation trends also show a clear bifurcation. Premium pricing persists for scale-ready assets in clean energy, financial services, technology infrastructure, and healthcare, while mid-market tech and consumer startups are experiencing more disciplined valuation multiples following post-correction normalization. The due diligence frameworks have also evolved, with heightened focus on regulatory compliance, ESG credentials, digital infra maturity, and revenue predictability. Overall, valuation resilience at the top end, combined with flexible deal structuring, is enabling transactions to progress despite market volatility, reflecting continued confidence in India's long-term growth fundamentals. Now, the India's edge in 2025-27. So we are a young demographics. We have a digital economy and a consumption boom. Then we have reforms, infra push. After reforms, we have infra push with China plus one advantage. India is also positioned as Asia's growth engine, and the volume and the value of the deals are looking positive towards the rise only. Let's talk about the future outlook 25-27. Now, India seems to be poised for sustained deal market activity over the next 2-3 years, underpinned by expected GDP growth of around 6.5% in 26 and 27, according to Moody's ratings, with global players seeking diversification away from China and domestic reforms, including privatization, infra inspection, and clean energy transition, gaining traction. Strategic, large scale transactions are likely to anchor deal value. At the same time, plentiful private equity dry powder, a robust mid market ecosystem, and rapid structural shifts in sectors like renewables, digital infra, and manufacturing will continue to support deal volume. Valuations may remain selective amid macro uncertainties, which depends on global interest rate, trade policy risk, but the underlying fundamentals, which is rising domestic consumption and infra build out with policy momentum, point to be a growth environment favorable for both strategic and financial acquirers. Overall, 25-27 is expected to be a period of transformation driven by deal making in India, characterized by fewer mega transactions dominating value and a steady base of mid market activity sustaining volume. So, our closing thoughts, India is not just resilient, it's redefining global deal confidence. The deal volume stable, volume value led by transformational M&A. India is also entering a decade of consolidation and innovation. There is a balanced scale with diligence and value discipline. I am now going to stop sharing the screen. Yeah, so I think we can utilize the time for Q&A.
Yeah, we have a hand raise also and questions that I can see. Um,
So yes, we will be sharing the presentation. There is a question that will you be sharing a presentation. So yes, we can share the presentation.
okay, so the first one that I have here is from Ishwarya. Given the lower value of deals, vis-a-vis volume and mega deals that have happened, are we seeing a preference for control transactions like acquiring majority stakes?
Yeah, so definitely that is the trend so far. The bigger companies would want to consolidate and increase their market share. That is the trend so far. Capability building is something that they are looking at in terms of joint collaborations. And one more pointer which proves that point is the value, the number of deals are going less, but the value is increasing continuously. That means the companies are aggressively scaling and tapping to get more and more market share, uh, backed by their capabilities of managing that kind of growth.
Okay. Guys, you may go ahead and shoot your questions, please. Vinitha has a question. Can you put some light on the deep tech sector? How do you see them adding value?
So, in India, generally, we follow the West. So in AI, you see a lot of companies are doing a lot of stuff in the US. However, India is also with the digital push. India is also very strategically placed to take the advantage of the infra that has been built around AI in terms of all the connectivity across India. It seems that the deep tech, because a lot of these people are aware about the science and the technology behind it. Also, I feel with the global transformation, I think India will get an edge for certain deep tech. If you see all the global lead players are their pedigree lies in India. So even Perplexity, for an example, is leading the way to AI, and from nowhere you see Perplexity being the top two or top three players globally. But the promoter belongs to IIT in India, so of course it goes back, and there will be a rise in deep tech in time to come.
Rachit, we have a few of delegates who just raised up their hands and want to ask the questions. I'm just allowing them to talk.
Yes, yes, Daya, please go ahead.
Hi, good morning. This is Neha. I wanted to know we are observing increasing trends of banks' equity participation by foreign players. Like you mentioned, Emirates and RBL, SMBCs, Yes Bank, Blackstone, and Federal Bank, etc. What is the main underlying reason behind it? One, B, do they look at it as their extension of overall portfolio in investment, or why specifically banks? The reason it gives me question is because different equity players will get to have accesses to the Indian banking system. And do you think it poses a risk that the decision making within for Indian banking system will get increased participation from their point of view or wishes?
Good morning, Neha. I'll break down certain questions. The first one that you asked is whether these Indian banks which are getting acquired, what's the main rationale behind it? Why there is so much interest? So I'll answer that first. Basically, if you see all the financials of these banks, these are very, very profitable banks in itself. And these are pure banks. They have less of income deriving from other things, but their basic interest lending and the interest margin itself earns them a lot of money, which is not the case globally. In globally, if you see, the income sources are very different than the main finance earnings that these banks get. So global banks are very interested to be a part of India because they see a lot of profitability for them, and there's a great margin between the cost of borrowing and the cost of lending, and they want to be around that in where they are able to continuously make profit. Secondly, you said, will it pose a risk going forward when these major banks, global banks, are acquiring the Indian banks, whether they will have their decision making capabilities or not? To answer that, I feel RBI is very, very involved in the banking sector. They continue to provide newer regulatory frameworks. Continuously, they are also evolving. Every single acquisition is very well thought and approved by the Reserve Bank of India, which still controls entire banking in a very structured manner. So I do not see it as a big risk. There could be that for a very big global bank, India seems like a good market for consistent returns. That's why they are looking towards it. Also, political stability is a big reason why they want to park certain money in India, and banking for them seems to be a very safe segment, because they know that with credit inclusion coming in, the banking will grow further across India. Like if you see tier 3, tier 4, now we are seeing a shift wherein the banks are able to reach and take care of those customer segment as well, because earlier we were catering to very, very limited population.
Thank you.
Thank you, Neha.
Who do we have as the next person who wanted to ask questions apart from Neha? Sandeep. Yeah, I can see Sandeep. There, if you could just add Sandeep quickly.
Hello. Hi. This is Sandeep. My question is regarding the route. The point that you have mentioned in your presentation that VCs and PAs are considering these IPOs as an exit route. Like two-thirds of overall money is in the form of OFS. So as far as my understanding goes, 2021 was the year when SEBI launched policies to allow loss-making companies to go for IPOs, and that is being used by all the VCs and PEs who have invested prior to that to use IPOs as the exit mechanism. So how do you see this trend? I mean, it is not uh, helping companies grow, but it is more being used like a like an exit vehicle.
Yeah, great question, Sandeep. So again, when we talk about IPOs, because there has become so much liquidity in the Indian stock market, that is one driver why all these big funds are backing up a lot of companies initially, because they are very confident that there is going to be an exit in future. It is like a cycle. If there is not enough potential to exit going forward, they might not be so aggressively investing in these companies initially. So, SEBI again has launched various regulatory frameworks. They are aware about it. From time to time, they are trying to protect Indian consumer interest at large. However, if these companies are not able to exit, they will be just stuck with that capital, and they will not have more revenues to invest further in the new Indian companies. So if you see, not all companies are loss making. There are many companies which have been profitable, like Grow, which is a recent example. And Grow has given great exit to their investors. Now, what essentially means is that when the early age investors are earning money, they're going to keep on investing in India's growth story. The money might not move out of India, but it might be reinvested again and again when this cycle keeps on going. So, uh, again, I think SEBI as a regulatory framework is on top of a lot of things. They'll ensure that consumers' interest is at large, but at the same time, they want these funds also to ensure that the compliance are in a way to support them as well, in case there is a demand for them to exit and there are people and there are takers who would want to take their shares. There is a clear exit policies to enable that.
I have a follow-up question if I may ask.
Yeah, please, Sandeep, go on.
Yeah, sure. So as a follow-up to that, what I would like to know is um, so as you know, there's an ample amount of data saying that FIS have not been investing in the secondaries because they are mostly investing in IPOs because that's where they see the momentum. And we have seen that happening in 2024 and 2025 as well. So what about secondary markets then? They are just investing in primaries. So it's just a follow-up question to my earlier question.
Yeah, so secondary market is also gaining traction, but if you see, the price discovery in the primary market is way easier. And all these big funds, they are pushing a lot of companies initially only. So you can actually think of that as a secondary market, because they take substantial equity when the companies are in the growth phase. That capital becomes very important for the companies to grow. And the main IPO route is the one they choose because there's a lot of liquidity available and the price discovery is fair. If a big fund exits very early, and doesn't back the growth, maybe that company doesn't see the light of the day to list in the main board itself. So it is like a cycle which all these investors are following. They are making money, but again, they're reinvesting. To answer your FI's data, I think it is a very sentimental thing. The domestic investors are very, like with the SIPs and all coming in, they're providing a lot of liquidity. So these FIs are actually are able to liquidate at a decent valuation, which is a win-win for both. So this is the kind of cycle which we are following.
Okay, I see Ashwarya's hand also. Just give me a second, Ashwarya. Yeah. Ashwarya, are you able to talk now?
Yeah, thanks, Sukriti. Morning, Rachit. Thank you so much for the session. I had two questions. One is a fallout of the question that Sandeep also asked, which is in terms of the secondaries market. So, in general, are you seeing any increase in the holding periods, especially for PE firms, and how does that tie in with the activity in the secondary markets? Because I think IPOs have picked up recently, but they're still not where it was in the pre-COVID phase. The second question was largely on the deep tech sector. So, I mean, I recall you mentioning that deep tech it seems to be an attractive sector, especially with foreign companies looking to invest in Indian deep tech. But how are you looking at valuations given that pricing seems to be a concern and there are also concerns regarding an AI bubble? So, is that momentum likely to be sustainable?
Sure, Aishwarya. The cycle definitely has been longer as compared to earlier, because if you see all the companies that have gone public recently, there is been at least 3 to 5 years of holding period. We'll take an example of Grow. So
Hmm.
it got invested around 2018, 2019, but it's gone public now after proving the concept of their business. So we feel that foreign investors have the appetite to hold for longer as long as they feel value. It is only when they feel that the growth factors or the demand or the company's performance is dipping, it is only then they are changing hands in the secondary sector. If the company is going robust and the growth matrix are all tick marks, the preferred route becomes the IPO, mainly because they are certain that they will fetch the maximum value out of the IPO route itself. Also, in an IPO, the price discovery is very clear. So there are people who are able to identify the future cash flows of any particular company going to an IPO route. And then accordingly, like if you say there was a huge momentum in growth stock, mainly because they see a lot of value that that company might offer in future, and that's the reason the investors would want to hold on as long as they are getting that decent return and growth from that particular company, which we have seen as a trend. Earlier, the appetite to hold was less compared to what it is now, and this has to do with the political stability as well. They feel that India has a stable government. The center as well as the state is majorly being ruled by NDA. So they don't see a lot of changes happening, at least for the next 2 to 4 years. And that's where their confidence to hold on to their stakes and companies is coming from. So I hope that's answered your first question.
Yes, Rachit, thank you. I just had a follow-up on that. Given that this phone pay is kind of filing for its IPO, which is more of an OFS, how are you viewing that, and what is your outlook on that?
PhonePe, again, a very robust company. It has a great distribution network within India. And as I said, our regulatory compliance framework has become very robust. One side, there's SEBI. They would want to protect consumer interest. Their main role is that a retail investor's hard-earned money should not go waste. It needs to be protected properly. That's why you see a lot of discussion around PhonePay's OFS IPO. It is only when our regulatory framework like SEBI, they feel that okay, they can be allowed to do an OFS. They are going to move forward. Till the time they are not confident, it's not going to happen, basically because they don't want the end consumer to have any kind of loss or some sort of risk associated. So when the risks are taken care, it will automatically go towards those approvals, and it's going to happen only then.
Got it, Rachit. Thank you.
Thank you.
Mehul, you may go ahead and ask your question, please.
Yeah. Thanks, Rachit. Great session. On the similar lines of discussions that we just had on OFS and IPOs, I just wanted to understand why do funds look for an OFS just before the IPO? Like we've seen this a lot in recent times. Bluestone shares have also been traded in secondaries just before the IPO. Similarly, for Grow, Peak XP went for their OFS before the IPO, and even now they hold somewhere around 16 to 17% stake in the company. So, what is primarily the mindset to go for the OFS just before the IPO and still continue to hold on the shares post IPO?
Hi Mehul, great question. So I think it's a lot to do with many factors, not one. To start with, there is a tax implication also. The OFS is essentially that the promoter is willing to offer their own shares. One is the liquidity factor, that the promoter is able to liquidate their shareholding initially before the IPO. Also, it is sort of diversification of risk as well. Because in IPO, if you see initially when the Zomato and the Nykas listed, there was a lot of correction in the price discovery. They had successful IPOs, but then the price went significantly low. It bounced back, but if you see, the performance of these companies improved really well, and only then they were able to bounce back to the kind of current price levels that they are at. But initially, such kind of things helps the promoter diversify the risk, or even for any investor, it is just like a diversification. Because end of the day, once you are listed, it is not just about the fundamentals of the companies, it is also driven by sentiments. A lot to do with sentiments. So if you see the same fundamental, the same growth patterns, the same financials of any company could have a PE of 10 or vis-a-vis a PE of 50. Essentially, PE of 10 would mean a very low sentiment, 50 would mean very high sentiment. So you can think of it as a diversification for the promoter of a particular company, that they want to dilute some and then ride the growth story of their company.
Got it. Got it. That helps. So
Thank
basically, it's mostly for safeguarding their returns for the investor side.
Correct. Diversifying their investment potentials, basically.
Got it. Got it.
All right, I have a couple of questions in the Q&A section also, Rajat. We can just quickly have a look. Divya is asking which sectors are showing a trend towards consolidation in this year.
Uh, so, Deveshri, do you want to should I take the question that you have mentioned on the group? Like, let's assume for a minute that the AI bubble will burst, Nvidia, MS, Meta will all crash. What do you think is going to happen to valuations of company using AI, and why? So I'm going to take that, what you have posted. So, AI bubble, lot has been spoken about. Of course, there are these companies who are investing into each other continuously. If you see, Nvidia is invested in a lot of companies, and the funds and are just in a circle flowing back to Nvidia. So AI as a bubble is too soon to say. And also US as economy needs something, to hold on to. I think AI is the flavor for them. Definitely the kind of capex investments that's happening in AI right now, in terms of return, is nothing. But there is definitely a very long-term potential in it. If you see the dot-com cycle, this was the scenario. But to say that AI bubble will crash this year, it's very difficult to say. I feel AI is still here to stay. It might take few years whether we can say the bubble is going to burst, but right now it is at very, very early stages. Also, it's going to change the way a lot of things will happen. So when internet .com crash happened, the growth was very consistent afterwards. We also feel that even when the AI bubble crash happens, again, there's going to be a growth momentum in this particular sector. It might be slow, but it's going to be consistent, and it's going to change the way a lot of things happen. I don't think so in 26 something like that should happen, because we are still far away what the data shows us. We are far away from any AI bubble crash, because there's a lot of investments that have already been committed and a lot of things happening around that space.
All right. Anil is asking, Rachit, if you can talk about a little on the climate tech sector growth.
So Anil, again, a great sector for the future growth. If you see, a lot of companies are moving towards climate tech investments, not only out of pure notion to make money, but also because they feel it is the need of the hour. Um, if you see, a lot of companies have now started putting climate tech under their ESG budget. They are not just investing it out of need, but also want. They want to have certain betterments in this sector. And this sector, in terms of growth, is very nicely positioned. I think time to come, climate tech sector will see a lot of boom. People are working around it, investing around it, but there is not one particular direction that it's going to, because it's every country is on its own doing something around this climate tech sector. Because when we talk about AI, it is like a consolidated shift, and everybody's globalized AI and they're working together it. But in climate tech sector, also there is growth, but the countries are sort of working in a very different, or in a very closed net kind of technology. It's still in a nascent stage, but yes, definitely a very interesting sector to look at.
Okay, I see another question here, which is by anonymously, put down. Is there a disconnect that you see between private and public market valuations?
So, in terms of the metrics, I think private, if we see private valuations, it is more about what the investor is seeing in terms of the future growth of the company. But when you see the public valuation, the price discovery is today. Even whatever the growth patterns the company might have in future, but the price discovery is very clear. So the future becomes uncertain, but the company current valuation becomes the correct price discovery, that the people are willing to trade the shares of that company in the public in the main board primary market. So you can think of it like this, that private, you can come up with any number. Nobody is going to question. But in public, the price discovery is pretty much accurate depending on the current market sentiments.
Okay. Guys, if you have any more questions, we can quickly take them. We have another 3 to 4 minutes that we can actually focus on, and Rachit can answer your questions. Rachit, we should wait for 2 minutes. Meanwhile, before we move on and welcome our next guest for the next session, guys, we can please take a moment to share your session feedback on the poll. There, if you could just quickly run the poll, there are only 2 questions, guys. Just quickly help us with your feedback so that we can do better in the next sessions that we kind of put across for you. Thank you. Okay, I have a question here, Rajat. Meanwhile, we can just quickly take this. Nina is asking, in the Lenskart IPO, there is deep discount in pre-IPO secondary transfer round. Reason for the same?
So see, if you see Lenskart valuation, it always has been on a higher side. It's they have come up with a price point which suits basically the investors who have held on to Lenskart since a decade. So if you see, they have been holding to the shares of Lenskart and sort of driving it since probably 2013 or 2014. So there's been a very huge holding period. And maybe because of that huge holding period, there is a deep discount in pre-IPO because these investors are looking to exit and probably reinvest in some other sector.
Okay. Guys, this is the second question that you see in the poll. Thank you. Thank you for the impromptu response. Rachit, I think we're in time to, kind of conclude this session. Any remarks that you would want to actually tell our audience? Any conclusion that you would want to end the session with?
So I think you have a very learned audience. Great questions, great quality of questions. Everything is very well orchestrated, very well organized. So thank you, everybody. Thank you to the entire team of of VC Circle to host this session. It's been a pleasure.
Thank you so much, Rachit. I think you've kickstarted the day with some of the excellent, highlights that we should actually focus on when it comes to the merger acquisitions and the PEVC market that we are looking at, right? Thank you so much for doing this with us. Thank you.
Thank you, Sukriti. It was a pleasure. Thank you.
Thank you. There we may remove the poll now. We can just quickly put it across back. Thank you. All right, next up, we have with us Mr. Suraj Malik, who is from the Legacy Growth organization, and he's going to focus onto the advanced deal structuring, convertibles, earnouts, and gift city models in this session, right? We will, ensure that he also, is putting across all the questions that you guys will ask in the session. Suraj, over to you, and we're excited to have you here with us. Thank you.
Sure. Thanks so much. And hey, Rachit, good to meet you as well. Glad being here, and interesting sort of lineup of topics, interesting sort of concepts. And, I think Rachit just set the tone of this entire sort of 2-day workshop. what I'm going to do over the next hour or so, and I don't know, Sukriti, do they need a break because this was supposed to start at 10:40, or we can just keep going? What do you think?
No, I think we can keep going. We could take a break after your session.
I hope so. I'm going to try to confuse you to a higher level so that you really need the break. But no, the intention on anything advanced, right? When a topic is advanced, restructuring, and I did look at the profile of some of you, etc. It is going to be at a little advanced level, so please ask questions. A webinar without questions, is very low on energy. So Kriti, you can take those questions, pause me, and ask the questions. I'm just going to share my slides, and we can start from there. Questions could also be a lot of experience sharing from what you would have otherwise seen in your careers, in your organizations, anything of that sort. Are the slides visible, Sukriti?
Not here to be ours. Yeah, now it is. You can just put this in a slideshow, Suraj.
Yeah, I just did that. Is that
Yeah,
a slideshow?
works. Yeah, good to go.
Perfect. So let me minimize a lot of other noise on the screen as well. So what is a deal, right? You all did a deal to come and attend this workshop. You keep doing deals with your siblings, parents, spouses, with your bosses, right? So it's like deal, like huddling. It used to be so much easy that, when we used to just, as kids, put our hands or do this, and there was a deal, right? We agreed to do it and we agreed to commit it. Modern day deals, because of complexity, because of issues, because of other things, have to be signed, have to be returned, have to be put to writing, etc. Right? So there are two elements of structuring a deal, that whatever people agree to do, the need of structuring is that you are making it easier. You are making it easier to implement. You are optimizing it for taxes. You are sort of ensuring it complies with regulations, or the process of achieving that is easier. So that is what deal structuring is, right? The underlying is a deal where people agreeing to do something and formalizing that agreement. And the second part of deal structuring is a lot of paperwork as well, right? Because modern day complexity, people, when they do paperwork of deals, just like when you bought anything, right? When you bought an iPhone or when you bought any subscription, you didn't look at the fine print, you just keep buying, or anything else, right? When you buy a holiday, same, when deals get done, of course there's a lot of negotiation, there's lawyers, there's advisors like us, who are trying to put a lot of corner case situations, preempting them and putting them into document. And that also needs structuring, because if that corner case hits, if something doesn't go as planned, like the last question on Lenskart IPO, right? If the Lenskart IPO hadn't happened, the documents would have also had different situations, different ramifications, different outcomes, right? So deal structuring is not just in the process of how you do it, but also in the process and the provisions that you have in the documentation that provide on how things are dealt with if you hit a situation. So a typical deal has these 4 or 5 stages. It has to go through this. It can start sometimes at different places, but typically when you're doing a deal, you first source an opportunity or target. When you're sourcing that, at that time only you're assessing strategic fit, you're seeing who else is going after that. So that's more like a filtering, top of the funnel process to say that if there is a match, it's like matchmaking. And that's what, let's say, investment bankers or CF, corporate finance guys do. To be able to do any deal, right? Whatever you buy, whatever you invest, there is a need for a price, which is determined through a process called valuation. And to get to the right value, right? Because see, this is very subjective. It is never, a buyer always feels that there is future value. Anyone selling feels that the value is maxed out or there is need for liquidity, etc. So that valuation process is estimating from different people, different lens on what should be the right price. And for that, you need to, normalize a lot of earnings, working capital. You need to adjust for debt-like items. You need to also compare, right? Because it is subjective, the only way you can get to a valuation is looking at some comparatives. Otherwise, how do you value an entity or a business? And the comparatives also are dynamic, right? Today, public market comparatives are very different from, let's say, what they were 3 years back. And were very different during COVID, right? So the comparative also changes, and that changes a perception of value. Where the structuring comes is actually in the next 2 stages, which I said, right? That because there will be gaps which are likely, right? Anything, as I said, right? Even you argue with your spouse or sibling, or but there's an expectation gap and there is negotiation involved. And then you're trying to structure it, right? You're trying to throw in a sweetener, you're trying to build some provisions. So, right, anything that you negotiate, you're trying to add elements so that those gaps on expectations are met because deals have to progress. And there is also an alignment on what the investor and the founder are looking at out of the deal. The tangible part of it, right? And that's why I'm saying it shouldn't be seen as structuring as only for legal, tax, or that boring geeky stuff. The tangible part, of course, will be you look at tax because no one likes paying tax, and you look at easing the regulatory process because again no one likes to get stuck in approvals and compliance and process, right? Ek baar deal ho gayi, once there is matchmaking and once you've crossed the pricing and all, you want to go faster and at the least possible cost. So that is where deal structuring is important. And then the geeky part comes in on reps, warranties, indemnities. All of this again needs structuring. Unfortunately, it doesn't end there. So as I said, right, there is whatever you do structuring at these phases, the real value of a deal is actually on post-deal optimizing, synergizing, integrating it, right? Otherwise, if the target and the acquire sort of act in silos, there's no value that emerges. So it has a great deal of bearing and things like rewards and retention for people itself and legal integration, right? You might acquire an entity, but you still have to consolidate the business. Sometimes you might acquire an IP. So this is what I'm just opening up your mindset that structuring is not just not Gift City or just not AIF or just not tax, but it is a mindset to ease the issues that around everything around a deal and to make deals happen. The role of when you're looking at structuring a deal is that you're saying broadly there is match. It is like a pundit to a marriage, right? There is broad alignment between families, and that pundit or bicholia is really trying to make it think to say if there are issues, if there are patri doshas, if there are anything, look at that and put it in a deal concept. That when you are kind of wanting to make something happening, you will end up having to structure it to get there. So it's a continuous process. You structure even before an investment or before it starts from there. So imagine a situation that there is an entity, it has businesses, typical family businesses, etc. In the same legal entity, you end up sometimes having the founder's personal assets. Could be a car, could be a painting, sometimes could be real estate, could be house. Or sometimes people have businesses spread over more than one entities, right? When they're growing, it naturally happens. So even before an investment or before a deal, there is a need to sort of consolidate the business, right? So that it is ready for an investor to look at, easier for an investor to invest, and you carve out whatever is not relevant. Sometimes you carve out also parts of a business that is pulling down the value or is sort of not as exciting to investors at that stage of time, and then you sort of bring it on later. So those kind of things will drive a pre-deal or a pre-investment structuring. Again, investors don't like a lot of cross-holdings, intra-group funding, related party transactions. These are actually quite showstoppers or increase the complexity. And complexity may not have as much financial impact as much it has perception impact. So to make it easier for investors to understand the structure, how the funding, how financing is moving, how decisions are taken, all of that has to be simplified so that when the investor comes in, they are inheriting and getting access to something they understand. They know how it is controlled, where the substance are, how things get determined, how banking is done, so on and so forth. And you would have seen, right, a lot of these IPO companies. We saw Pine Labs recently, Misho, Grow, etc. Right? There was a time where before investment, these companies were nudged to go offshore to Singapore, Delaware, etc. Because at that time, the popular perception was there is capital there, there is sophisticated investors there who will understand, quote unquote, loss-making startups, which we now call emerging or new age ventures. But they were loss-making startups from an India mindset, right? 5-8 years back, none of us would have fancied investing in a company which perpetually was loss-making. But so these companies in chasing capital, chasing investors, chasing outcomes went offshore. But today, with our capital markets being buoyant, our investors being more sophisticated, our depth or liquidity that is available now, they are coming back to India, right? So that is also, as I said, there's no deal when these companies come back to India, they can come back and still not list or still not get exit, but you have to structure it there so that you can do a fundraise or do a listing. So this is before an investment happening. During an investment, now look at it that you're ready now for a deal and you are now seeing a real transaction. The typical choices that is available with someone is, how do I acquire? Do I acquire shares? Do I acquire entity? Do I just acquire assets if I just like part of a business? Do I set up my own entity and hire talent, what we call acqui-hire, etc.? So these are various options that are available, and different circumstances, even in the same industry, same fact pattern, same valuation. But just like the circumstances of buyers and sellers are different, there is no template or rule book that this will be share acquisition or this will be business acquisition. It has to be fine-tuned and structured to the facts of each case. That's why it's a fact-driven outcome exercise rather than a playbook or template or something that you can ask AI or chat GPT. It will not arise out of that. So how do you acquire is the question that is solved. What instruments do you use to invest, to fund? Do you invest in equity? Do you put money as debt? Do you raise third-party debt? Do you use your own balance sheet? And there are a lot of structuring possible through hybrid instruments, what we'll discuss ahead as well. But they are all to do with things like convertible notes, preference shares that are convertible, optionally convertible. So that opens up an avenue, and that also opens up avenues to bridge gaps between transacting parties. A lot of times, targets or businesses that you're acquiring have tax attributes like losses, which are of value. Again, look at these new age ventures, sometimes GST credits, sometimes foreign tax credits. While doing a transaction, you can't take your eyes off them because there is value in those sort of assets. A company might have been loss making in the past, but let's say under a new buyer or acquirer, it has potential to turn around. And then those losses have value because in future you will offset them against profits. So how do you plan your transaction so that the losses are available to the buyer or the acquirer? And how do you structure the transition so that all GST credits or foreign credits, advance tax, TDS, right? There are small but significant items when it comes, and there are real money there, is where you need to plan. During investment also, right? That's why I said every time you plan an entry, you have to also plan an exit. Like you get into any room or any cinema or any building, exit is also as important, and you have to structure that. If there is an exit, who gets money first and in what order and in what frequency? Those things are called liquidation preference or a distribution waterfall. And this is agreed at the stage you are investing, because in later there is an afterthought. It can't come that you invested and the company went bust, or raised money at lower valuation, etc. We are seeing companies like Byju's and others, where the late stage investors, because of some rights, have preferential to whatever exit proceeds, liquidity, etc. happens, and that has to be sort of built and structured upfront while investing, and those exits would matter. And finally, as I said, right, during exit, so there will be deals. Don't just think that structuring is only when someone is investing or doing something new. When someone is thinking of exiting, the first thing that comes to mind is, I'm going to exit, so I will make money. Could be a gain or a loss. Typically on gains, there is capital gains in India and globally. So how do you optimize that, right? Because that's a real tax cost. That can I plan my exit in a way, so that I sort of am able to defer tax, reduce tax, optimize it through tax treaties. And how do I save myself if something goes wrong after I exit, right? So what kind of reps, warranties, and for breach of that, indemnities do I need to give or get? That kind of sets the tone on what kind of thing you need to plan. Ms. Pai, I'll come to your question. Maybe I'll just finish the thought here. I just saw something flash on chat. So this is on exit. Then how exit, right? Sometimes exit comes from a third party, which is easy, right? If there's a third party buying, a lot of times there are no third party buyers, but companies generate enough liquidity where they are able to return money to investors from their own sources. And to structure that exit, you need to do sometimes a share buyback or a capital reduction, or sometimes even liquidation. especially in a cross-border situation. So that enables shareholders to get access to money and funds that's locked up in the company, and again plan for taxes through that. You guys also would have heard a lot about leverage and debt push down, and investors want to optimize return on their own equity funds. And if there is an exit where either the seller is already delivered or the buyer is looking at using leverage to fund the acquisition, that structure also needs to work for the buyer. Like for example, in India, banks or most financial institutions don't lend to acquire shares. They are not permitted by RBI. It's kind of changing, and there are new norms or new safeguards that RBI is doing. But historically, there was a lot of RBI barring and again reluctance to fund share acquisition because shares don't earn. So if your exit, given that the buyer is using debt to fund it, you had to be structured as a business or an asset transfer and not a share transfer, because there was no avenue of having the buyer to use leverage. So that became important. And last but not the least is, after exit, there are a lot of filings, disclosures, competition law approvals. If it's cross-border, there is FEMA, tax, as I said, it keeps saying, right? Doing a transaction and sitting pretty and ignoring some of these compliances, disclosures, computation mechanisms is again very expensive, and the consequences of that are today the penalties and interest is far more than the cost of compliance or the cost of reporting it rightly in your things. So all this, as I said, warrants and drives structuring. I'm going to go to Ms. Ba's question now, where she's asking, as an investor in a company, should someone go ahead with CCPS or equity investment? So very fact specific, Ms. Ba. Generally, CCPS, the word means convertible preference shares, which are compulsory, right? The first C is compulsory. So it is an instrument that will convert to equity, but investors prefer to typically do CCPS instead of vanilla equity, given that the liquidation preference that we discussed or some preferential rights, it is easier to structure and it is far easier to enforce if they sit on an instrument that is beyond what ordinary equity sits with the founders. But prior to, let's say, an IPO situation or prior to a exit situation, normally this gets converted, right? Like in a company going IPO, you can't have separate class of shares, you can't have separate rights. So it will typically convert closer to a liquidity event. But investors would, as I said, right, when I'm saying typically, there could be situations where equity would also work, but you are not able to then structure preferential rights, given that at least corporate law in India and some of the other sort of English law following countries have limits on what kind of differential rights you can give to a shareholder. So yeah, Kushal is right that anti-dilution, etc. Right. So anything that has to be given preference, right? Preference shares का मतलब ही है कि वो preferential treatment है. So if there is a down round or if there is anything that requires an investor to get something in priority or ability to do something in priority, or even with lesser holding, control decision making in a company through reserve matters, through separate rights, because if a company goes to courts, etc., each class of shares is bucketed, treated separately, and you need approvals. So it's just far easier to structure and maneuver it there for investors in an Indian context. But I would still say there would be situations where an equity would work as well, given when you're doing a joint venture, for example, and you don't want parties to have differential rights, or where you are inducting an investor who's also coming in as a co-founder, a technology partner, right? So those kind of situations, ordinary equity also works as well. I hope that answers your questions, but please keep them coming, and Sukriti, you can nudge me if I'm missing anything. Am I going okay? Too slow? Too fast? Okay. So the biggest gap typically in any deal is price, right? People love to haggle and people love to negotiate. As I said, right, a buyer is getting into an asset for the future upside. So the lower that you get in, it's better, whether you're buying stocks, whether you're buying real estate, whether you're buying a car, right? As a buyer, you want to lower down or make the price as as sort of sweet as possible. And as a seller, it is your last chance to realize, maximize value, and you've sort of prepped well, you've pre-structured it. Uh, and your expectation, right, when you're selling a business, especially, you are really selling the moon to someone that, listen, I've built it up to here. All these things are going, there will growth on an Excel sheet, growth, or on a presentation or on a canvas slide, right? It's easy to show, demonstrate. In real life, things are very different. But as a seller, you're really selling the future, right? Because this is a business. This is not like a passive asset, or this is not like a bond where the future is capped or limited. So you will have to prep yourself and pitch for a higher realization, and a buyer will typically come to a lower valuation. So why is this required? Because you need to bridge gap, otherwise deals will not happen. And an earnout essentially means that a seller maybe today will accept for a lower price or a price formula, but in future benefit, if the expectation on the Excel sheet or the IM or the pitch to the buyer turns out true, the buyer is saying, I will not pay you today because there is risk, there is contingency, there is unknowns there. People might leave, market will change, etc. But if those situations come true, the buyer is willing to sort of pay extra. That is why it is earning out, and it protects the buyer from uncertainty. Just going to go to questions as well. So Divakar is asking earnout structuring in the context of slump sale BT. Okay, too many coming. We'll have to. I'll explain that, Divakar, with an example. थोड़ा mixed topic पे I'm getting questions, so I'll maybe take them towards the middle or the end, or if it's relatable to at least the side and front for everyone's benefit. How is earnout structured? It is structured by sort of looking at post-deal EBITDA or normalized earning, because sometimes a seller who's also prepping for sale is putting full steam, to increase growth, increase sales and all, because that's sort of driving excitement for a buyer. But whether it is normalized, whether it is maintainable, the seller might have done some new capex, whether it gives those results. So that parameter is what is kept under design and planned. Other kind of KPIs could be monetary, non-monetary, could be milestones, could be, let's say, for government business and infra business. The future could be they might have submitted a tender for a contract, or there might be a government plan to say they want to sort of do more and more, but they have not yet got it. So all these things are important. And in a startup world, just that when there is a deal happening, the biggest fear is the team would leave, right? And most sort of services or tech-based businesses are people. And earnout parameter is also nowadays common to say that the team stays back and then we'll pay you an upside. Otherwise, it remains there. So that's the typical thing that can get structured. How it is structured, there are some questions around that. I'm going to come to it. But basically, you kind of look at structuring it again in various sort of phases, various sort of possibilities exist. No one answer is true, okay? It is, in general, you would use more than one of these combination, etc. So while I'm going to explain them one by one, in real life, it could be a combination of multiple or something outside this slide as well, right? So the convertible, the preferential, right? Some of the questions also came there. Because there is a embedded option in the shares to say at what price or what value they convert, kind of helps to structure a deal that you can sort of convert at a later date. If the performance is higher, you convert at a higher valuation, which means investor get lesser shares. And if the performance is lower than what the seller held out, or if there are some surprises, if there are some skeleton in the closets that show up, then it converts at the lower price. So the seller is penalized, right? Because we spoke about CC and convertible notes, compulsory convertible, there are also optionally convertible instruments, could be optionally convertible debt or redeemable preference shares. Because in some cases, you also have to structure that if you don't need the money, or if the business generated enough money, instead of diluting, you want to repay the investor's money, you are able to structure that through the instrument of investment itself. At some time, maybe the instrument is not good enough, and then you have to sort of interpose an entity. The investor sort of invest through an entity, which could be a company, LLP. Sometimes it's with a founder or trust, and then you hold shares in the trust, and you're not because of restrictions on cap table or because of other investors there, or because of any constraint, legal, tax, you may not be able to structure the outcome on the main target entity. So you kind of structure it one level above at an acquiring entity or an SPV or an LLP or a trust to get the same sort of outcome there. So either you claw in to what the founder sort of, if the performance is not there, or you give an earn out to the founder. During the deal, sometimes, as I read, there's a value someone wants to exit fully. One way is to also safeguard and ring fence is to sort of hedge it by making the acquisition most staggered. And increasingly, this is how deals happen. Any deal that you read also in the papers, etc., you will see that there is a deal of 51 or majority, or it's typically spread so that the buyer is comfortable that the seller has skin in the game, is hanging around, and will sort of sell once some milestones are retained. And on the future milestones, either the earnout can be given or the future milestones can be bought cheaper. So it kind of makes it far more easy for both parties to do. Very, very stringent sellers who are stuck on something, and who sometimes also you don't trust the buyer whether later, we are only seeing that if the seller or the target delivers. Imagine if the buyer goes belly up or bankrupt or have cash issues, and it happens in real world, right? That you sold a deal and you agreed to an earnout, but your buyer doesn't have capacity then. So some sellers who are smarter or rigid or whatever you might want to call it might insist the buyer that fine, you're not paying me today, but you park that money, you sort of show me the money, identify it, put it in an escrow, release it to me when there is the outcome that happens. And this is more common on things like where there are tax or legal claims or litigation because of which the deal price is adjusted, or there is a settlement with any customer or supplier. But on the point of the deal, it is open. You don't know, it could go either way, right? A big tax litigation, for example. So parties will say that because this is not linked to performance, but linked to an event or an outcome. So they would insist money being parked in an escrow or shares being parked in an escrow, so that the earnout is then easily on a click of, once that event happens, no one is resitting, no one needs to regroup and put their minds together to arrive at this. The consideration can also be, as I said, deferred. The consideration can be made contingent. All of that is possible. Sometimes you didn't plan earnout well in the pre-deal and deal. You can then end up a situation where there is a post-deal situation where you need to cancel shares or give someone more shares. And that's where situations like rights issue you would see in companies for planning things like earnout or anti-dilution. Or reducing share, cancellation shares, founder leaving and investor sort of not committing, investor investing in tranches but not fulfilling those commitments. All of those situations will also trigger some of this structuring and will be implemented. At times, the earnout is not necessarily only for shareholders, but also for key employees, team, etc. And those structurings then can't be done through cap table or investment, but more through the company in terms of a phantom share, a bonus, a lot of structuring around sweat equity ESOPs, and MSOPs basically stands for management ESOPs. Those things stand there. I'm going to jump to the questions a bit. And meanwhile, if there are any more on this slide, can come in. So I'm going to take Shilpa's question first on how earnout shares, how advisory shares are structured. This is common in a Shark Tank era, in an era where there are a lot of people claiming to be mentors, advisors, incubators, who want shares for free. When I'm saying free, which means without money, and they want to come on the cap table for some effort, indulgence, fairy touch, whatever they are doing for an entity. Those shares are commonly referred to as advisory shares. Typically, these shares, the more early you structure in the life of a company where the valuation is lesser, think of a celebrity asking for this to do endorsement, to post to Insta videos. And when I'm saying celebrity, it could be an Insta influencer as well in today's world, not necessarily a Bollywood or a cricket celebrity. And you have to give shares to them. You have to share upside with them. So if it's structured early where the value is less, it is possible to sort of issue them shares. It is possible to do a small secondary to them. And again, do it in escrows, do it in some of these deferred payouts, because if I'm a celebrity, I'm fairly active on social media, you like me and I meet you today and we are all excited, and you give me 2% of your company and tomorrow I ghost you. There is no way you can enforce that, right? That I had to post or I had to help you, right? I can help you, but if I ghost you, then you're stuck. So it has to be structured like a earnout that the celebrity or the influencer or the advisor or the mentor has to access those shares once those conditions are slowly met. So you would build in a ratchet to either buy back or cancel them, or a secondary in an escrow, so that you're able to carve them out. But at late stage companies, Shilpa, it becomes harder and harder to get to that. So Yash has a slightly technical question. Yash, maybe we can take that offline as well, because enforceability is possible even if you exclude terms. For private companies, you can overcome the act if the articles and the shareholder agreement so provide, but happy to take that offline. Misbah is asking, can CCPS holder ask for rights as same as equity shareholder? Yes, in private companies, again, our law and the 2013 Act allows for rights to be on par or preferential for CCPS as commercially or contractually parties may agree. So they can sort of make it stricter or increase the bar. If the Companies Act has an approval requirement for something at, special resolution, let's say, needs 75 plus 1 share. For those items, you could lower the bar, and even an investor owning 5%, 10% can have those rights. It is possible. Puneet, case study of earnout is in next slide. I'm going to come to that. I know abhi hum theory thoda hai. Could you explain put and call option, Divyashri? So a call and put option is basically first you have to understand it is an option, which means it is a entitlement, not an obligation. So if I am an investor, let's say you are a founder, if I have a call option on your shares, I have a entitlement to buy your shares, not an obligation. And if you have a put option on me, at certain milestones, you have entitlement to sell, but I can't force you to sell, right? So the important point to understand is optionality to the holder of such an thing. And the scenarios that this would work, let's say, again, I invest in your company and you're a great founder, and you promise me that, you are at 5 crores this year and you will be 25 crores next year. And I will say, fine, you achieve it, it's fine. But if you don't, and you do only 7 crores, then I want a call on your shares and I want to bring in another co-founder or etc. Right? Or I want to penalize you because you sold it expensive to me. Or I just want to make sure that at some stage I own more of this, even if it's 25 crores today, I own 20%. I want to then make it my business 51. So I want to lock in my right to acquire more shares, and I need that option. But I don't want to give an expectation to you that the day you need money, you come and sell, right? So that could be a call option scenario, and vice versa for put, right? Where investors are saying we want an ability to get out tomorrow if there is an secondary option available or if there is liquidity, etc. They want to retain that shares. And you guys would have heard things like tag, drag, ये हम गेम खेलते थे बचपन में. Tag essentially with an option means you can tag with someone who's selling, and drag sometimes is an investor's ability to drag others, right? So if the investor is selling, an investor owns 10%, and there is a buyer who's saying I'll invest only if I have 50%, then you can drag other shareholders. So the optionality with tag and drag kind of works well. What can be a deal breaker point in an M&A or a VC transaction? Misbah, everything can be a deal breaker. Sometimes the coffee on the table people don't like in the end. It's very emotional. It's cold feet, right? Look at a relationship. People fight for no reason. And the VC world and the M&A world, we've seen deals break for various reasons. But I would feel ethics in negotiation, transparency, a lot of unknowns getting discovered in due diligence. These are the things, right? Because I said a pitch book and and I'm sure you guys look at deals. And why do most of Shark Tank deals don't go through, right? Because when they post the episode, discover both sides, right? the investor discovers something which was not on the show or what told, and there are things, and sometimes the founders also discover that the deal that was being offered in real sense is not what I want. And by then, maybe the show gave me so much traction that my sales doubled, tripled, quadrupled, so on and so forth, right? So deal breaker could be anything. As I said, people develop cold feet. Any transaction, both parties are nervous, both parties are confused, and both parties are trying to optimize. Bad advisors is also a big deal breaker, right? Because if you don't have a right facilitator to make it happen, right? इसलिए मैंने शुरू में I spent time there, right? That some of y'all, most of y'all, when you're all as advisory role to a deal, uh, it's your role to keep that momentum going, have a solution-oriented mindset, and not get. I'm saying protecting your client's interest is one, but not get rigid to not have the deal go through for sometimes not so important points like information rights and some preferential rights, etc. Nina, I'll take your question on upfront tax and cross-border. We have some slides on that, so we'll cover that. Vinita is coming in again for private companies. Yes, thanks for clarifying that. That was the answer, I think, to Yash's question. Divakar, your question is FOCC, which means a company which is Indian company which is majorly foreign owned. This is a question on FEMA. Give a contingent consideration to an Indian entity during a BTA buyout. So a BTA buyout typically will be the FOCC buying a business from another Indian entity. As such, if it is not like a structured loan, but it is only a payout linked to real business milestones, there will not be any restrictions. But if there is an element of an hidden sort of debt arrangement between the transacting parties, which tantamounts to leverage in a way that you're allowing a payout period. So deferment, I would feel, is most sticky. Contingent linked to a genuine business case, FEMA would not restrict that. Thanks, Kushal, for clarifying that entitlement is all the holder, but the obligation is on the person, right? So that is how it would work. So the holder, when I explained, it was from a holder's context. Okay, let's progress, right? So typical, someone wanted an example on how a pre-deal earn-out structure is there. Removed numbers, made it very easy. Just think founders, right? As I said, want 1,000 crore valuation, and investor was 800 crore. The X or Y could be anything. So how do you kind of achieve, right? An investor is investing into this company. So you typically invest as a convertible, could be a convertible note, preference share, convertible debentures, depending on other things. Right now, we are only solving for price. And you say that the conversion will depend on, let's say, 12 months, 18 months later, the real performance, and when the DCF becomes real, right? It's not just a projection. So if it's a higher valuation at the time of conversion, the investor will get less shares, so the founder feels happy. And if it's lower valuation, which means whatever was on the projected Excel, jahan pe growth dikhana, I keep saying, is very easy. It's a formula. You kind of have a lower valuation, right? So the convertible-ish structures solve well for the price gap over here, and there could be other structures for other issues there. The beauty of this is there is no tax, on this whole, let's say, floor and cap kind of valuation or changing valuation, because there is no new instrument being issued. There's nothing being exchanged. It's just the ratio that is being changed. And in a cross-border context, also our RBI regulations, etc., permit this as long as the entry price is, or the floor price that we call, is determined upfront, and that is the fair value, right? So once you enter at fair value in future, you could convert it at different values, could be higher than that, etc., right? So it's possible. And again, our tax laws also enable this, because even if you sit on a convertible instrument, especially CCD, CCPS, any period of holding, all your cost basis, all the tax attributes that your investment had prior to conversion are available to you on exit, even post conversion. So the period for which you held the CCPS is attributed and available to, when you share shares, your cost is available. So there are enabling provisions for all of that, which makes this as one of the most often used structures to overcome price differential. Now, this is a case study on where, there is 100% sale intended, but the buyer wants to play it safe and saying, okay, I will take 60 crores. So let's say there's 100 crore, there's an alignment on that, but the seller is asking 140, 150 crores. So the parties do transact at, let's say, 100 crores. So 60% buyout means the buyer pays 60 crores today. And there is a call option to the buyer for the remaining 40, but it is linked to, let's say, 2 years ahead, right? We've put FY27 year EBITDA, saying if it's less than 20, then I'll pay you the 100 crore value. So I'll pay you 40 crores. If your EBITDA is between 20 30, there is an upside. I'll pay you 60 crores for the 40%. If it's more than 30 crores, I'll pay you 80 crores. So the implied valuation for the second tranche, depending on the EBITDA, which was 100 crores today, and let's say the current EBITDA was also in that 20 crore or below range. If the performance doesn't come, the call option will be at the same value and the seller would get the same. But as the performance improves and as the outcomes improves, the implied valuation goes up. And now the seller, if he would have sold everything for 100 upfront, potentially can get through the second tranche about 140 crores as well, right? Depending on how the company performance is there. Now, while this solves for the upside on earnout, the earlier case solved for the conversion and shares. While structuring this, there are other things because this is like two parties will jointly operate. So how things are controlled, because to deliver the performance, the seller will also say, give me space, freedom, autonomy. How do I drive the performance if you come in with 60% and don't allow me to pursue certain initiatives to increase this EBITDA, right? So those things that's why I'm saying is agreed, like handshakes, but also put in documents, put in the deal docs, agreed there, put in articles. So all those rights are there. And in this case, if a seller again wants to hedge, what do if I don't know that you will have payment in future or ability to pay me, insist on an escrow, and parties kind of put shares and money in escrow. Our tax laws are designed in a way where if the tax guy feels that the deal got locked today and it's only money exchange happening later, there is a risk of it being taxed upfront as well. It is like if I buy Sukriti's house today and pay her 2 years later, she has to pay tax today because we did the deal today. Capital gains tax is not linked anywhere to money coming in under any situation. If there was any party who was non-resident here, the only thing that FEMA or exchange control needs to plan is you can't give guaranteed returns to non-residents. When I'm saying equity also includes CCD, CCPS, etc. You have to give them market-linked or fair valuation-linked returns. So structuring that through valuation formulas, etc., becomes important. And if this was a listed company, I'm just saying, right, it's bigger on tax and all, then you have to also look at SEBI regulations, which call for more disclosure. And if there's an upside sharing agreement with some investors, or there are takeover code implications. So you need to plan and look at all of that before creating this. Abhishek has a question here. Would not case study option create conflict for existing promoters? No, I don't think it would create conflict. This is an incentive structure for them. And let's say it's typical. Let's say if this was a typical family business, Abhishek, where, till there was no investor, tax planning, under-reporting numbers, cash sales, etc. was common. But now that there is an external investor who wants everything on the books, right? Because it's sort of, they don't believe in whatever was off books or underreported or, more expenses put for tax reasons, etc. All that will get cleaned up. Sometimes this increased EBITDA in a lot of family business getting taken over by larger corporates or investors, just that jump in EBITDA comes from process efficiency, transparency, booking things properly. But yeah, if the growth is linked to capex and if the existing founders under the deal docs don't have right to do it, that's where it creates deadlocks and disputes and stuff like that. So it has to be planned holistically. And I'm saying not just one advisor saying this, but the other advisor or a lawyer looking at the deal docs kind of doesn't build in the necessary safeguards, tools, resources for this to happen, right? Then it will sort of conflict and people will end with disputes and deadlocks. वो नहीं होना चाहिए is the goal. Vandana is asking, can a call option be included as a regular transaction, which is not necessarily an acquisition? I don't fully understand what the regular transaction is, but generally on What is not allowed is forward sales, and all right, on securities, which is only in listed, you could do forwards, but you could have call options, which is only defining an entitlement and casting an obligation on the other person, like someone said. You could have it on regular transactions as well. It could be a call option on buying inventory or doing a transaction or anything, right? So as an optionality there, it is legal, and the mechanism in SHA, which is shareholder agreement, to do that is to ensure that for exercise of this call option, if there are board shareholder approvals needed, then the party having this option should have rights in the SHA to be able to cause them. Because let's say I'm a 5% shareholder and I have a call option, but on the SHA, there is also need of approval of other investors. There is need of approval of founder in some cases. So it can't be in conflict with them, right? Because someone will rely on the SHA to block it, and I might rely on my SPA or contract to do it, and that is chaos. So the mechanism in the SHA is to make it consistent, bring it on par so that everyone is on the same ground. And that's how things happen and people don't end up in courts. Okay, there was also a thing of an example of, we discussed if you can structure a deal as a business transfer or sometimes like a demerger. So this is where shares are not getting acquired. Company has, let's say, two businesses, U1 and U2. Technically, we call them undertakings. But this can be done. And when businesses are being exchanged, money is being paid, of course, there will be tax payable. But for our tax purposes, you don't look at sort of individual assets in that business, or could be depreciable assets, could be everything. You treat it as one unit and you pay capital gains as long term and not as short term. And the GST laws also enable such sort of restructuring and M&A by saying that when you transfer inventory standalone or asset standalone or itemized or what we call cherry picking, there you'll have to charge and pay a GST. But when you transfer a business as a whole on going concern, with all its paraphernalia, with employees, with contracts, with whatever it needs to maintain the going concern status, then there is no sort of GST as well. The flip side of it is because the entities remain, right? So there is no way you can pass on tax losses or tax credit. That is not available to the buyer. But the buyer benefits from getting a step up in cost basis for depreciation, because if A's assets were depreciated, because B is now paying a consideration, so it's sort of for future depreciation, the cost basis goes up. One big spoiler in India for such things is stamp duty, right? That's a significant transaction cost, because one is state-wise and it is fairly high rates. And when you transfer businesses, they are treated as movable properties. They are treated as, conveyance, and you need to pay stamp duty. If properties are in different states, then you have to also pay it at a state level wise to mutate those things. So this is an example where business is transferred as a slump sale. Now the same thing, let's say if someone wants to do it in a cashless and a tax neutral way, here the consideration, right? The same business U2 is moving to company B, but B is not paying to A. For a demerger, what needs to happen is B will issue shares to the shareholders of A. So A gets nothing. A's business is moved out into B, and B will issue shares to shareholders of A. And if you structure it this way, there is no upfront tax that is payable. So neither A pays a tax, neither shareholders of A pays a tax, neither do B pays a tax. You kind of do this without any cash and tax flow involved. But you kind of need to go to the courts or the NCLT now under Companies Act and do it like a process to be followed, which in India, given how courts function and how the process is, it takes 6 to 9 months at times to do it. There is a fast track regime under the 2013 Act that is possible. But the way our tax code is defined, and that kind of has not sort of synced up with this whole fast track, and the tax code expects demergers to happen through the NCLT process. So there is a little bit of white space in law. Hopefully it gets clarified soon. And for tax neutrality, right? All the thing, the period, cost, etc. So in the slump sale, while company B got assets at a stepped up cost basis. Here you will not get any stepped up in cost basis because no one is paying a tax. In that, company A was paying a tax, here no one is paying a tax, so you don't step up your cost basis, etc. And again, GST also is not there. Stamp duty on demergers is treated differently. It's under a different sort of head of conveyance. And again, each state has a different mechanism of taxing it and looking at it. So that needs to be structured and planned for appropriately. That is what it is. See a question from Puneet saying Rule 11UA. Let me maybe explain it closer to context of maybe along with buyback or something. I'll explain that. This is a case study where our Companies Act allows, without going to an NCLT, for a company to return money to its shareholders. And this is possible at times with some safeguards, right? Because the law generally restricts shareholders taking money out. Dividend can only be paid out of profit. And because creditors, outsiders dealing with a corporate want to make sure that suddenly shareholders don't vanish and run away with the money. So the law kind of limits how much can you take out as shareholders beyond dividends. So they've capped it at 25%. And they've said that you can do this only once in a year. And for a company that is leveraged, they've said that after doing this, your debt equity ratio cannot happen 2:1. So for highly levered companies, also the law is saying that shareholders shouldn't expect to take money out as buybacks. Dividends generally lenders would not allow if their thing is there. So it's a safeguard for them. The big catch here is even if your debt equity is less, you can't use levered or borrowings for doing a share buyback. That is clearly not permitted. So this buyback, then what the law is really saying is has to be done out of your own sources, which is earnings, could be out of share premium, or could be out of new capital, right? So it is not levering and not sort of external money, but sort of capital kind of money or profit that is being used for paying back shareholders. We've gone quite a bit of flip-flop in taxation of buyback over the years. It used to be capital gains, and then a lot of non-residents took advantage of it. I'm not going to cover everything, but last year, mid-budget onwards, and now also, what change is there at today? Whatever is paid as buyback is treated as dividend. So the taxation is in the hands of the shareholder and not in the hand of the company. And because the proceeds are treated as dividend, the cost basis of shares is treated as a capital loss. So it's a very unique way of taxing it. It's sort of inspired from UK, where again, foreign shareholders took advantage of law for several years. And that's why the government brought in a very different way of saying that any return that a shareholder gets from a company, we will treat it as dividend, which is taxed at the highest possible rate. So in this context, maybe I'll explain the 11UA as well, what Puneet has asked that there is. So 11UA is a rule which basically tax authorities have put to say that if parties transact below a particular value, we will notionally deem a value, how you determined under Rule 11UA, as the value for the transfer. So it's a notional. If I sell shares of, let's take a listed company example, if I sell shares of Reliance, which is let's say 3,000 bucks today at 2,000 rupees to someone, the tax guy is saying we are assuming you got the remaining 1,000 at difference because the market price for a listed is the Rule 11UA value. So they will tax me on 3,000 even though I sold it for 2,000. For an unlisted company, etc., also, that there is a rule to determine how do you arrive at the minimum value or the Rule 11UA value, where it is the book value adjusted for certain items, especially shares, real estate, etc., where you restate those at their fair values or circle rate and arrive at the value. Now that value doesn't apply to buyback, but that value is really to safeguard the tax authorities' interest that if people artificially transact at less than obvious values, if we put it that way, which they believe is book value for a private company, adjusted book value, and the market value for listed companies, the tax rule says that the delta we will treat as income for both the parties, capital gains for the seller and ordinary income for the buyer, because assuming buyer also gave cash, so has some unaccounted money, and that is how they want to tax it. Balaji has an interesting question saying if a data room is created and financial and legal diligence is done and everything is done and there is a disclosure letter. So disclosure letter, Balaji, basically in your case, right, that the seller has shown everything to the buyer or their advisors, and later the whole issue, right? Let's say it is a staggered or an earn out. Let's say there was a tax issue, or let's say there was a legal case and it was disclosed there. What a disclosure letter does is tomorrow, if that issue really comes up, the seller is saying that, listen, Mr. Buyer, I had already told you, and this is already factored in the price that you are paying to me today. So if you're already factored it today, you will sort of not further adjust the price or the value or not come after me to recover it under any of the indemnities or the rep clause as well. So the data room disclosures are a good reference point that should be there, and it should not be made independent of that, right? Because the data room is the formal way in which data has been shared to the buyer. Yes, from the buyback change, the capital reduction requires going to NCLT, and not exactly NCLT, it's an NCLT application, and there is a 90-day waiting period. And tax for capital reduction also, especially when you do out of profits, is similar-ish to buyback. It's not exactly the same. So investors, as I said, right, laws of land, sometimes you can not wish away with. So with the change happening, if there is money locked into the company, the tax is high. Again, for investors who are covered by tax treaties, there is still some arbitrage because the taxation rates in the treaties are lower or are beneficial compared to, let's say, resident investors. And that's why when these IT companies like Infosys, etc., who used to do buyback earlier also, now the participation is lower because the tax or the post-tax return on that is fairly less. So cap reduction, given the process involved is frictionful and there are other issues, it's still not very commonly looked at in how things are, and everyone is only hoping that the government would, because they flip-flopped it about 4-5 times in the last 5 years. So that is it. I have just few slides and I think we have almost reached our session timeline. So if I go fast next 2-3 minutes, okay, I want to keep 5-10 minutes for Q&A as well. So this whole thing, right, and as part of advanced structuring is what you should know. This whole flip-flop that has happened on companies that went overseas and with capital markets being fairly buoyant here, they are coming back for listing opportunities, for their customer base being here, etc. And there are various ways to do it. The first company that did it maybe did it in the most primitive way and paid very high taxes. And today there are far more sophisticated and ways to do it without paying a tax. But essentially, when the companies went outside, the situation was there was an Indian company, and that Indian company was struggling to attract investment or raise capital or do something. So what they did was they flipped, which is the middle diagram, where they interposed a foreign company between the Indian company and the investor. So the cap table sort of emerged at that foreign company. And today what is happening is that through structuring, they are trying to eliminate that foreign company because you can't list that in India, or you can't, only an Indian entity can list on the Indian exchange, and investors for exit need to be sitting on an entity where they can do an offer for sale or an exit. So that is how reverse flipping is happening. And to make this happen, and really we have a listening government and a regulator that both under our Companies Act and under our exchange control, right? Because to imagine foreign India mergers, you have Companies Act, you have RBI regulations, you have a host of other things. There have been enabling provisions and deemed approvals to make sure that this happens. And in our tax code, even prior to all of this, there were provisions to say that we will not tax or we will not go after any of the issues if it's done within the framework of this law. So this is just perhaps my last point. I'll pause now and maybe keep 5 minutes for Q&A before the next speaker takes over. Any questions on GIFT City topic in 1 hour? Puneet, not possible. We can maybe do a separate session or something on that. If you want, I can. How much time do I have, Sukriti, now?
You have another 10 minutes.
Okay. So I can explain Gift City then without slides as well, and you guys will understand. Gift City is notionally foreign. It is a place, if I don't know if you've been, it is a place in Gandhinagar, which is about 20 kilometers from Ahmedabad. So it is in India. Okay. But notionally for exchange control, which is FEMA, that place, businesses operating there, funds operating there, banks operating there are treated as foreign. So this is very similar to people who've been to Dubai, what a DIFC or offshore is looked at there, or what Jersey was to UK, etc. That within the geographical boundaries of our country, we have now delineated a space to say that this will be treated as foreign for exchange control laws. Okay, everything else the same. The Company Act regulator is same. The tax regulator is the same. The country is the same. There is no visa you need to go there. So it is a city which is Gujarat International Foreign City, and it is governed by a separate regulator. So what they did that in India, you have Companies Act, you have ROC, you have Ministry of Finance. All of these are regulators, even for RBI or banks. To make it easier, they built in one super regulator there called IFSA, and that super regulator is only making it easier and more easier for businesses to operate, because banking, operations, structuring, Gift City, all provisions are determined by one regulator. There's no arbitrage of separate regulators coming and creating confusion and making it harder. It is essentially meant for just two kinds of businesses. One is financial services. As I said, right, a lot of our brain drain beyond tech was also all these fund managers, people going abroad and setting up funds in Mauritius, Singapore, etc. So that whole fund industry, we were losing talent as well as not capturing that here. And the second was an SEZ equivalent, right? We had SEZ for a while, but this is at a very different scale where the Gift City has an SEZ component which is meant for export. Gift City is not meant for doing business with domestic market, as I said, right, because it is notionally separate. So you can't do trading or you can't do services or whatever, right? Within India, it is meant to be offshore to offshore and offshore to global. That is how the government sort of designed it. Perhaps in hindsight, they believe it would have, if it would have kept in BKC or Bombay, it would have been far more bigger than what it is today. But over the last 10, 12 years, it's no longer a ghost town. There are 30,000-40,000 people working there. There's real estate, there's hospital, there's etc. And it is the only place in Gujarat from a structuring standpoint where you can get alcohol. Otherwise, Gujarat is a dry state. So they have sort of internationalized it to a level where they are encouraging these funds or these financial services entities or branches of bank to come set shop here, because that base effect starts playing in India. Today, all of that base effect was if you've traveled to a Mauritius or a Singapore or even Dubai, not now, but when they started all these Dubai offshore, right? Just the base effect of money being managed and controlled is a tremendous economic activity driver or a puller, right? So they wanted that economic activity to come back to India, for all these ecosystems to develop into India and make it in a way that is regulated, there's control. They also have set it because the tax and the regulator, otherwise India, they also have better visibility on quality of money, better visibility on what's really happening, how things work, how fund in a global context operate. And this also happened at the same time where Indians had started investing more and more abroad, right? And they needed the right channels and path to go to. So currently it is incentivized for both Indians as individuals or corporates that if you want to make financial portfolio investments, you can do it through Gift City. And there is a regime of funds which is well established and all. And there are a lot of foreign banks who set up branches there and who used to give ECB loans to India, used to lend to India. All that activity is there. So Gift City as a concept, I'm just saying, is not a structuring, and why I skipped that topic is not that because I don't know it, but as I said, right, it is a physical space delineated from India notionally to encourage, as said, financial services and export businesses. But beyond that, from a structuring standpoint, when we look at GIFT City or a Mauritius or a Singapore or Cyprus or US, it is all foreign, right? So whatever in our structuring context we said was foreign or FEMA. So anyone coming through India from GIFT City is like the same laws will apply if you were a Mauritius or a Cayman or a Singapore or wherever, and vice versa from India. If you're investing overseas, it is covered there. So that's the reason some of you all got excited that the topic is not being explained. It was more from a relevance-ish and covered elsewhere. But hope it addresses your question. Okay, Divya has a question on. There's some music being played. What are the benefits of investing in India through GIFT City? So I don't think there is any tax benefit anymore under capital gains or treaty and all. There are benefits to the manager or the fund manager entities there in terms of what they earn. But if a foreign investor is investing, whether through GIFT City or directly, the tax outcome is the same. To promote the ecosystem there, the tax incentives are more to the money managers and the institutions, or less, I said, like the banks branches there are doing ECB lending, where there is lower or nil withholding, or there's no GST on carry, that kind of stuff. Yeah, Sukriti.
So, I have two questions in the questions segment. I'm not sure if you've answered this, but Shilpa is asking, can an investor invoke SHA which provided for guaranteed exit in 5 years to the company is making loss?
Yeah, I mean, if your rights are there, you can provide or you can trigger it. It is all in the commercial contract. What is in the commercial contract can be enforced and fairly well in India and current way how the judiciary operates. And
Okay,
that
the
is
next one here. Yeah, the
Yeah.
next one is here, which says, can you share some good online or offline resources for a non-lawyer industry practitioner to keep up with the tax laws, the tax treaties, etc., required for structuring deals?
the world of ChatGPT, everything is there, but I would feel there's good content on VC Circle. You should subscribe to the paid one. And yeah, as I said, newspapers, there's because different people are covering different facets of it, legal, tax, financial. There is no one repository, but Google Mata and ChatGPT and VC Circle should be able to give you all the gyan you need.
We keep on doing these trainings, so I don't think that's required here. Thanks, Suraj. I think, have you taken this question by Mispa? Is it good for a promoter where we have a couple of more questions coming in?
Okay, sorry. I go to the Q&A or the chat?
The
Is
chat.
it good
It's
for a
the
promoter
chat,
to
yeah.
go ahead with a... देखो, good bad कुछ नहीं होता मिसबाह. It is what is a ROFR, which is a first refusal, and ROFO is right of first offer. Now, if the initial, well, let's look at a founder. I'm a founder, and Sukriti is my first investor, and she's asking for this. Okay, I might be willing to give to say, I don't mind Sukriti investing more in my company. She'll also help me with visibility and put me at other things and all her network, right? You all are her network. But if it was a real estate don who kind of still gave me money, and money is a money, I'm just trying to amplify. And I'm saying, aaj chahiye na, money was money, I took it, I built my entity. But in the next round, I want to go to Sukriti or VC or the cohort of this batch. And I don't want to be necessarily carrying that investor along across rounds and all, because I just don't feel that there is value add beyond money there, right? Initially, I needed money. So you have to deal by deal look at to who you are giving this right and what does it mean for you. Because if you give it and if that undesirable or non-value add shareholders, right? And today's time and it's not just about money, right? VCs and PE. A smart founder will look at beyond money what benefit of associating with that ecosystem of the investor they get. And the investor, can the investor help them in subsequent round, help them in business, etc. So you give some of these rights to people who add value and would want this more than someone who might just want it for vanity. And assume you give it, or let's say I assume I give it to Sukriti, and if she goes rogue and she blocks me from raising money from anyone else, etc. Right? Those are the unhappy situations you want to avoid. So you have to be, there's no good and bad. It has to be a judgmental call taken vis-a-vis your needs and investors. Yes, there is a MAT equivalent, Abhishek, in Gift City, which is a very fine print issue, but there are taxes there. It is not that as if there are no taxes there.
Hold on, Divakar. I will just quickly unmute you. You will be able to talk to Suraj. Yeah, go ahead.
Yeah, hi Suraj. Thanks for the session. So, just one question on the slum sale again. So, as you mentioned, as I remember, there's a concept called deferred consideration in a slum sale. That you can only defer 25% of the amount for 1.5 years. But as you had mentioned, we can defer any amount as long as certain business milestones they're tied to certain business milestones. So, just wanted to clarify that.
Sure. So you've sort of slightly jumbled two regulations. The deferment under FEMA, which is RBI, for a transaction, let's say between a non-resident buyer who's paying you consideration, that regulations allow up to 25% referral for 18 months. In a slum sale, and I think your question was also FOCC selling a business and getting a deferment, right? This is in context of that.
Yeah.
So the deferment for share consideration versus, as I said, right, a deferment for a domestic transaction where there's no FX involved. So an FOCC company buying business, and if they are deferring payout linked to a real business milestone. See, because for downstream investment, it's more than deferment. What the regulations don't allow is for an FOCC to lever domestically, right? They need to bring money from offshore or use internal accruals. They are trying to control that. And the deferment is strictly not a control. So if there is no element of a credit here, right? You defer just because you don't have the money. And I'm trying to, build in like a disguised credit line to the buyer. As long as that is not the issue, I don't think deferment for a business milestone is prohibited in an FOCC doing a slump sale purchase.
Okay. So you are saying this FEMA regulation of 25% is not applicable on an FOCC as long as the deferment is linked to genuine business milestone.
Not applicable on an FOCC slump sale with a domestic transaction. Giving you the full so that there is no. It is applicable when they are doing share-ish deals and all, because what is applicable directly is applicable indirectly as well. But in a BTA linked to genuine business milestone linked payments, it technically doesn't apply.
But why does it apply in share purchase then? Because the same logic.
It applies in share purchase because you can easily hack what a non-resident couldn't have done directly to have a deferment by just putting an entity in the middle. If you would have been able to hack the law by saying otherwise 25% cap. So let's say a non-resident wanted to buy shares from you and you had this limitation, right? That you have to realize the money in 18 months and only get 75% upfront if that company puts an entity and which buys from you. And then if you say this doesn't apply, you are hacking and you're beating the system, right? Down by that. So downstream investments of shares by FOCC require reporting, require valuation, are governed by the same conditionalities as if the investor offshore was doing it. There are specific provisions in FEMA to say that FOCC downstream will be sort of on par with a foreign investor investing directly. That's the logic.
Okay. In case of share purchase.
Exactly.
Okay. Yeah. Thank you.
Balaji, I have run the hand raised from Balaji. I will just let him ask you the question here. Balaji, please go ahead.
Yeah, thanks, Sukriti. Suraj, thanks for the nice explanations regarding that point which I raised on disclosure letter. I think you said should be dependent. So my worry is if they are not committing to that and there are 2000 files in the data room and some document somewhere protects them while there is a claim later, how do we protect that? Should we insist on that or the specific disclosure letters to be drafted, or should we still allow them to refer to the, data room for any kind of disclosures agreements? That's the worry.
As you said, typically you lock the data room a particular date because it's not continual disclosure. So once it's locked and there is an index and there is a list of documents there, at least for material items, if the disclosure letter can actually talk about the list, where it is disclosed, that would be because the whole purpose of the data room was to enable a buyer to be fully aware.
Correct.
It's not like a buyer beware and someone walking blind. So the purpose is that then it is right on part of the seller to hope and claim that the buyer doesn't sort of double dip into an issue which they've already valued. So the seller's starting point will be there. The buyer will of course say, in spite of you showing me, I didn't appreciate, imagine it then because you put it in fine print. So as I said, this is negotiation, but it is not wrong on the seller's part to say that if I've disclosed you something today, you can't come after me later. It is like a car sales guy showing, I'm showing you a scratch today, and this is the scratch. Now, tomorrow, if underneath that scratch rust start developing, you will say, you show me the scratch, but not the rust, and I'm coming after you, is where they will try to disclose, right? This was already told to you. So same in a deal. I'm sure what you're really saying is beyond what is disclosed, there could be finer points, there could be other ramifications which a buyer in the diligence period is not able to absorb. That is the buyer's starting point. So again, it will have to be negotiated, and the structured answer for a good advisor to be at least material items let's list down, and then not make it just data room wide, but maybe you can have 20, 30, 40 items of specific disclosures to be part of the transaction document, so that for those specific disclosures, there are no claims or counterclaims made later.
Understood. Thanks, Suraj. I think that makes a lot of sense. Thanks a lot.
Thanks, Balaji.
All right. Thank you so much. I don't think we have any more questions. Suraj, you can give us your closing remarks. Meanwhile, Daya, I would request you to quickly run the poll and then we go for a quick break. Right, guys, we'll go for a quick short break. We'll come back at 11:55 and then we resume with our third session for the day. Suraj, please go ahead.
No, I think I had fun and I really enjoyed questions coming in that made it more interesting for me, particularly. And I feel that how you've stitched this over 2 days and all, it's fairly and rewarding, as I said it, in today's time and age where whatever I said is also available on AI and Chat GPT. Just that these forums allow us to indulge, and I would urge participants even for other sessions, ask questions, get as much more of the experiential thing which the speaker can bring to you.
Yeah.
And not just hope that Sukriti will send you a recorded version which you will never listen to. Sort of make your presence count.
Thank you, Suraj. People would be looking forward to your presentation as well. So we'll be sending them across after the training. So thank you so much for doing this with us. Right. And you've been a huge support in all the trainings that we've done so far. And we sort of look forward to having you for further sessions as well. So thank you so much.
Thanks. Have a good day.
Thank
Bye.
you. Thank you guys for voting out your suggestions on the poll. We may take a quick break and then come back at 11:55. Thank you. Hey, Vasudha.
Yeah, hi.
Okay, so I think most of us are here. We are good to start. I will quickly make a couple of announcements. So, hi everyone, welcome back. Our next session is led by Ms. Vasudha Madhavan, leading voice in private credit and structured finance. She'll cover bank financing for M&A and growing private and credit-led credit landscape and much more. Vasudha, over to you. You may share your screen and we may go ahead.
Yeah, hi. Do we have a Q&A sort of session also, or how are we doing this?
Yes. We'll do it once you're done with your presentation, Vasudha. People will any which ways keep on pouring their questions here.
Okay, all right.
Yeah.
Um, can I share my screen? Does that work?
Yes, please. Yes, please.
Yeah, are you all able to see my screen?
Yes, Vasudha, you can just put it in the slideshow. Currently, we can see the upcoming slides as well.
Yeah, sure. Is this better?
Works. Good to go.
Okay, great. Hi, everyone. Good morning. My name is Vasudha Madhavan. I'm an investment banker by profession with 22 years of experience. What we do in this space really is we help companies in making very important and key capital strategy decisions, which are critical for their growth, as well as, in cases where the promoters have other strategic goals like exiting the company or in bringing in strategic investors, etc. We also help with that. So there's a fair level of connection or a deep interdependence between the business strategy and the capital strategy, and this involves talking to or liaising with multiple types of global and Indian investors, as well as corporations, as well as sovereign funds. So what we'll do today is just get a little bit of a flavor of how all of this has evolved in the last few years. It's also important to note that we are India's first climate tech focused investment bank. For the last 10 years, about 12 years into my corporate banking career, investment banking career, I decided to start something on my own. And it is a sector focused investment banking firm where we are known for our work in the electric mobility space, the clean energy and decarbonization space. So these are sort of also a domain expertise that we have in all the areas related to decarbonization, and we help those companies raise funding from various sources. So there is a fairly sort of, you can say, thematic approach as well that we do as a firm. Today, I will cover a little bit around a broader strategies around M&A and PEVC playbook, which is really how financing and funding is happening. If you all need anything specific or any questions that you have and you'd like me to cover that, please do drop it in the comments or give it to Sukriti and she can send it to me and I can cover it during this meeting. Yeah. So India's deal ecosystem is at an inflection point. So what's really happening here is that from being a very traditional sort of bank debt driven economy, which we used to be maybe 15 to 20 years ago, we have very different. We have moved in the direction of private credit and private equity. And this transformation has happened in literally the last 1.5 to 2 decades, which is when you started seeing private equity investments into Indian companies, which formed a very valuable alternative to raising either capital from the public markets or from banks. So if you really needed an alternative, I think for the last 15 to 20 years, you started to see meaningful alternatives, and it has now reached a you can say, a fairly mature level where companies are able to grow using private capital without going to the public markets or even going to banks. Because some of these businesses may have limitations on how much bank debt they can raise, etc. So I think there has been a pretty meaningful change in the capital landscape of our country. Some of the new categories of investors and capital providers that are emerging are written here. So we have now got private credit funds, which are really funds that basically they are pools of capital that are raised from limited partners or from institutions and they are meant to essentially they are meant to be lent or given as loans or to businesses which can be priced differently or structured differently from a typical bank loan. So private credit can be quite useful in structured finance cases and situations as well. Uh, uh, is not like they are the fund. Is look and we those private family offices will really private pool and these refer to either basically owners of businesses and promoters or any ultra high net worth individual who could be having his or her own private capital and deploy. Family office
Guys, please give us a minute. I think she's logged off due to the network outage. Vasudha, we're not able to hear you properly. I think there's some network issues from your end. If you could just quickly check the internet.
Yeah, am I think I'm back now. Is it fine?
Yeah, this is better now.
Okay. Let me know if there are any issues. I think it did drop a bit.
Yeah, you may have to reshare your screen, Vasudha. Yeah.
Okay, family offices, like I was saying, are private, are the private wealth of individuals, and they also have now professional investment strategies, which means that they participate in direct investments into startups, or they participate in other funds which are raising, which are venture capital funds. So they come in as limited partners into those funds. Sovereign funds are also another hugely important emerging category, and they've been in the last 10 years or so, we've seen them become very much active. Today, India actually enjoys the opportunity to get investments from many different types of sovereigns, including sovereign funds are really the capital or taxpayer capital of different countries. Okay, so you have sovereign funds which are really set up by country to invest some bit of risk capital into either startups or areas that are of interest as per that country's preferences. So these normally represent pools of capital that are drawn from the citizens of that country. All right. That's a sovereign fund. The shift is reshaping how transactions are structured and priced, and it is also driven by liquidity cycles and rising promoter expectations and investor appetite. So we are seeing these new types of funds emerging as we go forward. So basically what we can make out is that we can draw the conclusion that founders now have more funding options than ever before, and selecting the right capital partner has become significantly more because you do have more options, right? Yeah, so talk a bit more about private credit. Private credit market has gone, these are global numbers. They've grown from you can say from 20, they've grown quite significantly. Sorry, let me go back to the slide. Has moved quite, has changed quite significantly from to about 25 to 30 billion. And this was a number for FY25. We believe that there has been a rapid expansion in the market that these funds are targeting. They also deliver anywhere from 13% to 25% returns, 20% returns on a yield basis, and these tend to be quite attractive for investors. So private credit has also become quite attractive to their limited partners or investors and as an investment vehicle because they do deliver attractive returns for their partners. And obviously become a source of non-dilutive capital for the founders, which means that if you don't want to dilute your shareholding in your company, you are going to be able to access this pool of capital, which will come at an annual operating cost, which is the interest cost, but will not really have a dilution in your own stake in the company or the other investor's stake in the company. So this becomes a good source of non-dilutive capital. Activity has accelerated in the space, and we now routinely see that in most of the equity fundraisers, there is also a element of element of debt or private credit that comes in. These are also used very important in bridge funding, which are companies about to do a large fundraise, need something in the interim. As well as in special situations like buyouts or in turnarounds or company takeovers, etc. So there could be various situations where corporate situations where private credit becomes quite valuable. Today, if you're, and these provide a good alternative to traditional lenders. It also executes faster. I mean, speed is also important. Private credit takes comfort from either potential equity investors or of course some kind of cash flows that they're able to see, etc. coming up. So they take a slightly more risk. They're not as risk averse as traditional banks are. So they do take a more forward-looking kind of an approach to a company's cash flows, and they are able to lend in situations which may not be suitable even for bank lending at times. Yeah. Yeah. So that is on private credit. It enables faster and predictable deal execution, although this typically comes at higher pricing. So this is important to know that these loans or these can have often warrant structures or convert. They can be an equity kicker in the structure itself, or there can be which means that on top of the interest rate that you're paying, you will also be giving the investor some equity options, which could give them an upside. Is my voice rendering okay right now?
It's breaking in between, Vasudha, a little, but still, I think now it's better. Audience, please let us know in case if you're facing issues. Hello?
Yeah, is this better now? Am I audible?
Yes, right now you're audible, but in between the voice is breaking, Vasudha. Maybe you can just continue for now.
Yeah, that's cool. I just changed my network. Yeah. Okay, cool. So we just move to the next type of, next big change that's happening, which is the rise of family offices and sovereign wealth funds. All right. So it is estimated that India has more than 300 family offices managing over 30 billion in capital. And many of them are actively participating in direct investments, which means they're directly coming in, taking stakes in companies and quite a varied range of family offices actually, anywhere from 10 lakhs, 50 lakhs, all the way up to $50 million. I think today there are family offices that take very large stakes. And when I say the larger end, we have the likes of Premji Invest or Catamaran Capital, etc., which are Premji investors, Azim Premji's, Wipro and Azim Premji's family office. So, which is structured, with a large number of, very competent investment professionals. So when you have a formal and a professional way of running a family office, you are obviously able to make private investment decisions better also, rather than just the public markets, which also, of course, requires a fairly detailed approach. So many of these family offices today have a range of investment strategies that they're executing with the help of trained investment professionals. So more and more what's happening, and we see as a trend, is that family wealth is becoming more formalized. It is coming into private and public markets in a more structured fashion, thanks to entities being set up to target investments of this capital, and also these could be provide a much needed diversity to the broader investment landscape. In addition to this, we have sovereign wealth funds, which are also increasing their exposure to India. Now, in the case of sovereign wealth funds, it's slightly different because they also look at country risk and they look at sectoral risk within the country and so on. So as we have been, showing signs and showing evidence of fast growth, and we're becoming a very attractive market as a country, with not just, I mean, top level numbers like GDP growth, etc., but also the fact that multiple sectors like deep tech, climate tech, etc., are growing in the country, which means that these businesses are growing in size, they are also increasing in profitability margins, etc. So now we are able to see that these sectors are also, these sectors are also able to attract a fair amount of investment, and so so essentially what we do here is, we look at. I'll come to questions in a bit. In their investment focus, often they have remained very impact focused. So sovereign wealth funds, when they come in, they tend to be quite impact focused. They're looking at social impact. They're looking at sectors that typically don't get capital, and they're able to essentially they are able to target these sectors which don't normally get capital and are important for the development of the country. However, we are also now seeing that they are expanding their investment focus into broader infrastructure, advanced manufacturing, and other long-term business-wise strategic sectors. All right. So family offices can offer flexible relationship-driven capital, while sovereign wealth funds can provide scale, stability, long-term alignment, for larger fundraisers. So, ESG linked financing gains. So, so essentially what's happening is, are you all able to hear me? Am I audible? Am I audible? Yes? Okay.
Yes, Vasudha, yes.
Okay. Yeah. So, so essentially now what's also happening is, as a theme, one second. Yeah, I think my camera went off. Sorry. Yeah. So by December 2024, India's cumulative green social sustainability linked debt issuance had reached $56 billion. Okay. So essentially what has happened is ESG linked financing, which means that we are talking about funding or capital allocation which is sensitive to ESG priorities. Okay, ESG is environmental, social, and governance related priorities. So it actually helps that today, whether you're a debt fund or an equity fund, you are, or any type of an alternative investment fund, even a foreign portfolio investor, you will be able, you will have to, you will be mostly being, seeing a push from your limited partners or your investors or even by the government to track some of these ESG linked outcomes of your investments. So how is your portfolio company tracking on these lines is something that would be interesting, and that will give you even benefits around interest costs because it will be connected to the achievement of sustainability metrics. So this is something that we do for a living at Ostara, and we help companies that are making true progress on their sustainability metrics raise equity capital as well as debt capital. All right. So how do we see this, right? Now, all of these are new sources of funds. We've spoken about family offices, credit funds, and sovereign funds. Founders should plan their capital stack early by determining how banks, private credit funds, and sovereign funds, etc., can complement each other. So this basically means that if you have plans to raise capital to improve your to grow your business in the next 2, 3, 4 years, and you're probably starting a business or you're at an early stage of your business, you should be able to actually take advantage of all these options available to you and plan it in a way that you start with maybe, let's say, early stage private capital, private equity, and then or venture capital, seed funding, and then move and be in conversation with private credit funds or venture debt funds, etc., and to be able to take advantage of non-dilutive capital from time to time, right? And these just provide you many more options to raise debt and equity as compared to when you only had the banks, right? There are even, in fact, sources of grant capital that we haven't covered here, but especially when it comes to ESG related businesses that you may be doing. All right. ESG. So ESG and KPI. So what we do is when we look at attracting some of these funds, right, either sovereign funds, even family offices, it helps to have the capability to negotiate sustainability linked KPIs so that these metrics are also tracked in your business, and this helps you directly influence pricing, investor appetite, and lender selection. So always, it is, if you are looking at some of these alternate sources of capital, it helps to also track sustainability metrics in your own business. It could be direct or indirect sustainability impact that your business could be having. Founders should also cultivate long-term relationships with family offices and sovereign funds, and these investors support growth in the later stages. So what is also important to understand here is that every different category of investors relevant at different stages of the business. All right. So at an early stage, it could be a family office or venture capital fund. At a slightly growing stage, when you are in Series A, B, you could heavily look at venture capital as well as private credit. Then you could start to look at sovereign funds, which come in at a Series B and C and later stages, which are really to do with the maturity of your business and the ticket size that you're raising. So founders should also align early on governance, capital mix, and intercreditor dynamics to ensure smooth execution, avoid last-minute renegotiation, and protect valuation through the deal cycle. So these are things that we also look at, which is how do you protect your governance right from the start, and how do you go through the process of funding, because you're not going to stop with one fundraising. You will require capital in a repeated way. So you want to look at who to raise it from when and how to manage the execution and the terms and conditions that you sign up to, because if you sign up to something that impacts your capital raising going forward, that's never a good thing, right? So all right, so yeah, that's a little bit about all of these. I think what we want to say is capital partners are really important partners for the company, and it's important for the founder to actually target the right kind of investors to support your journey at specific stages. So yeah, that's a little bit about what I wanted to cover today. Yeah.
Thanks, Vasudha, for that. Guys, if you have any questions, please feel free to drop in here. And you can also give us hand rates so that you can speak to Vasudha directly on your queries.
Yeah, I do see a lot of questions.
Yeah, so I have a question from Khyati here in the
Yeah, I
chat,
do see
Vasudha. You
a
can just, probably have a look and you can answer.
Yeah, so I think the question from Khyati is why are sovereign wealth funds investing in Gift City and what's the benefit they look at in Gift City versus investing in India outside of the Gift City. See, Gift City is actually like it's essentially meant to be a tax tax. Set it up, you can set up, invest capital here with, and you can avail of some interesting tax benefits like zero capital gains or no dividend distribution tax, and so on and so forth. Even in cases, I think you could have no GST, etc. So it depends on the business and depends on the regulation, but those are benefits that you can avail of, and you also get tax holidays for 10 years and so on. So these are incentives that reduce operational cost and increase net returns for sovereign wealth funds. So that is why they are looking at investing in sovereign wealth funds. However, it is an option that India has made available to some of these. Also, what can happen is if you want to set up a fund in India, it can give you the benefit of international norms. You can bring in international capital into the country more easily if you're a fund who's constituted in the Gift City, etc. So you credit private equity, hedge funds, FPI vehicles, foreign portfolio investment vehicles, etc. in Gift City and be able to raise capital. So both as an investor to invest into India as well as to raise capital from external investors. If you are an Indian AIF, you can use the Gift City. There are basically, it is differentiated by 2-3 aspects. It is tax benefits, simpler regulation, faster approvals, and more flexible investments that you can do as compared to. So the compliance aspects can be better managed. So those are sort of some of the benefits of the Gift City. I hope that answered your question. Yeah. Anyone else?
Okay, guys, are there any more questions that you would want to ask Vasudha? Let's just wait for 5 more minutes, Vasudha. We shall see if there are new questions coming in
Sure.
at all.
Sovereign fund. It's called National Investment in Infrastructure Fund, NIIF. They also have a collaboration with India. Yes, it is active. Ather, Mahindra, and more recently in Eka Mobility, which is an electric bus and commercial vehicle company. NIIF, that's the India Sovereign Fund. Can you hear me now? Is it better?
Your voice is still breaking, Vasudha. I would suggest you
Let me
can just
switch
go off
off
the
video
webcam
if
for
that
some time and then
helps.
see. Yeah, a little better.
Yeah, so I was just saying that India has a sovereign wealth fund called the NIIF, and they make several investments into electric mobility companies. They're looking at multiple companies and areas which are of strategic interest to India, including, yeah, I won't speak for them, but they're called the National Investment and Infrastructure Fund. They're India's sovereign wealth fund, and they have multiple funding vehicles. You should look them up. They made a range of investments, and they have a large amount of capital under deployment. Yeah. Is it better now? Are you able to hear me?
Yes, Vasudha, it's better.
Yeah. All right.
Guys, go ahead. If you have any questions, you can give us a hand raise. You can speak to Vasta directly.
What is the typical rate of interest in case of EV driven? So, yeah, so EV driven businesses, we typically raise equity because if you are a high growth business, then it helps to raise equity. But if you're raising debt, you do have the option of approaching the priority sector lending kind of targets from the banks. In case that doesn't work, I don't know if I'm still audible. But in case it doesn't work, you can always look for bank financing as well. But I would not say that it is cheaper than bank financing if you're in the EV business.
Vasta, we have next question from Divya in the chat itself.
Yeah, given that the ongoing funding winter, PEVC investors seem to have a lot of dry powder, but the uptake in investment doesn't seem to have happened. What are some of the reasons? I mean, funding winter, I don't know, it keeps happening from time to time. I would say now that we are, it depends on which sector. Just answering the previous one, LP for NIIF is Indian government. So, like I mentioned to you, the sovereign funds are taxpayer or capital coming from the public of the country. So the LPs are governments. So that's the LP. I'm not aware of whether there's a funding winter or not. What we typically look at is we are seeing that in our areas, which are electric mobility, industrial decarbonization, clean energy, renewables, battery materials, recycling, circular economy, supply chain, so many areas that we tend to target. There has been a huge growth, in fact, a massive growth in investment in these areas. These are sunrise sectors. So we don't see a funding winter. Potentially, I think if there are sectors that have matured or have burnt a lot of money, the investors are becoming more conscious of profitability metrics, and hence, if you are a business that has raised 100, 200, $500 million and have not yet cracked a profit, likely that you will not be able to access further capital at mature stages unless you do manage to achieve some of those profitability metrics. Thematic funds focused on electric grid modernization, supporting net zero. Yeah, there are multiple thematic funds. We work with many of them. It depends on the stage of the company. We tend to work only on deals which are $5 million and above. Just that's also answering the small. We don't do small funding. We do anything that is $5 million and above. And we do in areas where, I mean, we would help a company that has already managed to get to a ARR of at least $2 to $3 million and has raised at least $1 million dollars or $2 million in funding from either family office or institution. So we come in at a slightly more. We don't do early angel and pre-seed and all of that. Yeah, there are lots of thematic funds on grade and net zero and all of that. Most PE funds have diversified into multiple asset classes. What's your view on the reason for? Yeah. Yeah. I mean, I would say most funds, I think some folks like Edelweiss would have multiple vehicles and so what. It really depends. 361 has multiple vehicles and so on. I think it's not really about, it is about diversifying for them because diversifying can give you better returns, but also it is to do with different return profiles, risk return profiles in different companies, right? Different type of investment strategies. So that is something that funds have done to diversify their own risk return profile. So you could, and each of these funds, which if they have different strategies, they have typically different professionals, teams that are handling this, which understand that. So I think that would be how it would be. So it's normally not the same team. It's different teams that handle it, and the diversification is meant to increase and improve the risk and return profile. Many VCs seem to be chasing climate tech investments. Is it a founder's market? No, not really a founder's market. They are chasing investments, but that also means that there isn't enough good companies that are available. Yeah.
Vasudha, we have a question from Devakar here as well.
Just give me a minute.
Guys, meanwhile, please go ahead and keep sending your questions in. We have enough time to address all of them. In case if you want to speak to Vasudha directly on any queries, please feel free. We shall let you speak to her directly here.
Specifically, so IRR returns in climate tech projects are 12 to 15% range. Return ratios are lower, but we see a P. IRR returns in climate tech projects. So I don't know which ones you're referring to, but what we see is that climate tech is a very nascent area, and we most of the investors who are entering here are looking at the next 3 to 5 years. And in those timeframes, return ratios can be much higher than this. So therefore, investors are coming in looking at those returns, which are all the way till 2030, 2032, and so on. So that is the typical investment time frame for investors, and therefore those IRRs in that time frame tends to be much better than 12 to 15. Yeah, it's just that the market has not reached maturity. So as it reaches maturity, we start to see better companies, and good companies is also, it's not that there aren't enough good companies. It's just that there are a lot of companies which are doing fantastic work at an innovative stage. They need to be supported with capital. And if they get that support, they will be able to grow to the next level, right? So that's what I meant by when I say good, what it really means is for different investors, they're looking at large companies or scaled up companies. That is relatively fewer right now in number. Yeah. We truly believe that there are lots of really good climate companies. That's why we are a dedicated investment bank really focused on that. Views on recent M&A financing rules. I don't have views on this right now. Yeah. Anything else?
Guys, we can still answer questions for another 5 minutes. So in case if you have any other query, any other question that you would want to ask or know more about what was that just spoken, please feel free. Vasudha, we shall just wait for 2 to 3 minutes and see if we have any more questions coming in. Meanwhile, if you could just give us your conclusion remarks regarding the session here.
Yeah, I mean, like I said, right, today I think founders have a wider range of options. So you are able to tap into multiple types of capital. If you want to make a smart investment decision, then you should always look at a mix of debt, equity at the right time of your growth strategy. And good advisors can help you, of course.
Awesome. Thank you so much, Vasudha. You've set up the context really well, and thank you for answering so many questions here with us. Thank you.
Yeah, no worries. Pleasure. Thank you.
Thank you. Guys, we'll bring in the poll questions again. Please quickly share your feedback with us. It's not going to take more than 10-15 seconds for you to just vote of how you feel about the session. So there, can you please have the polls up? Thank you. Thank you, guys. Thank you so much. These feedbacks would actually help us come up with better content and trainers moving forward. So, thank you. Guys, since we finished up the session early, we can take a break and then come back soon for the next session, which will be the last one for today, and will be, of course, taken by Mr. Anil. So please, let's just come back for the last session around 12:55, so that Anil can start in time. We may take a quick 10 minutes of break that we can. Let's come back at 12:55. Guys, we are waiting for Mr. Anil to just log in. Just spoke to him. He's logging in. He was into some other meeting. There is no delay as such. We'll be starting shortly. We're just waiting for him to come in. All right.
Hi, can you hear me?
Yes, sir, we can hear you. Good afternoon. Thank you so much.
Good
All right, guys, we'll now quickly transition into hands-on case clinic led by Mr. Anil Talreja. He will analyze the landmark deals of 2025, valuation bridges, integration challenges, and biodynamics. Anil, over to you. Thank you.
Sure. Just checking if you can see my slide. I'm just about to present it.
I'll just confirm. Once we see it, I can just confirm quickly. Yeah, we can see the slides now. You may just put this in a slideshow and then you should be good. Yeah, good to go. Thank you.
You can see the whole slide? Just
Yes,
checking.
yes, yeah.
Super. Okay, friends, thank you very much for your time. And I just thought uh, it is important for us to touch upon some of the critical practical aspects of doing a deal. And more particularly, I am focused on case studies. Uh, I know that you've had conversations till now about, uh, kind of the legal aspects, the practical aspects, and I also recognize that, since I'm aware of the other speakers who've spoken before me, I think it's also, I mean, I'm aware of the fact that there have been a good conversation I'm sure you would have had on some of the technical aspects. So this conversation is largely around, what are the practical structuring kind of issues and how does one, put up a playbook, so to say, when you're doing a transaction, when you're doing funding and lots of other structuring aspects that I want to cover. Now, here's where I'd suggest we can kind of proceed. Uh, I would recommend that each one of you uses the chat box to the extent you can, because keeping this more interactive is what my objective is, frankly. So if there are any questions or if there are any interruptions that you want to do, go ahead and put yourself into the chat box and type the message. Just before we start, maybe it may be a good kind of time for me to request all of you to maybe type out in the chat box what you think, how important is structure to a particular transaction. So structure as in the structure of the deal, the contours, as well as uh, the the funding of it. So maybe if you could please open the chat box and type out, according to you, how important is the structure? It's very important. Is it something that perhaps you feel can come in later, or has it to be dealt with upfront? I would love to get that thought. So, any further thoughts? I do see Anusha's comment. I will address that, but can you please use your chat box and put down? Okay, that's very nice, Khyati. I fully resonate. Divya, yes. I'm just waiting for a couple of seconds to see if, yes, Bhushan, structure is very critical for lenders, very critical to see investors. Covenant security, yes. Okay. Okay, and maybe my next question, whilst thank you, Kushal, thank you, Shilpa. It is important from tax, Rama. Now, if you may also now react to another question I have. According to you, thank you, Abhishek. Yes, it is important, no doubt. According to you, what is your kind of awareness of the structure? Do you think that your knowledge of the structure is quite advanced? Is it perfunctory? Is it more basic? The reason I want to get that is because then I can kind of, discuss for the next hour or so. Accordingly, I can pitch the conversation so that it matches your understanding. So I would love to get that. Okay. Thank you, Bhushan. I know for some of the answers that I have got to the answer to the first question, it clearly indicated that most of you are quite advanced and quite proficient in your subject. So I'm really, really glad, and I'm looking forward to this conversation. Okay, so why don't we start? I think keep using the chat box. That's what is in front of me, and I will also ensure that I keep looking at it if there are any questions. If you feel at some places I should go slow, I should go fast, you want me to deep dive into certain things, let me know. Okay, I've got a good feel about all of you in the room, so I'm going to start. So, what are we going to cover in this session? We're going to talk about setting some context. We're going to talk about some motives of an M&A deal. We will also be discussing a few case studies because until and unless you get to case studies, you can't kind of understand the nuances in a very practical sense of the term. And we'll talk about certain other considerations. Now, when it comes to structure, tax, funding, one of the most common aspects, I think, which you all need to remember is that it is never static. There is no static situation. Things keep changing, things keep moving, the law changes. Uh, just last weekend, we had the data privacy rules that were issued by the government. So, again, lots of action. What's the implication? Whilst these are more proactive implications, but once you are into a transaction, and we will briefly discuss, you also have to recognize the past implications. So, does that create an additional amount of legacy in your hands? So, that I think is important. So, as I said, this context, I think what is also important is the various contours of the deal. So, what you see on the slide in front are the big buckets of the deal. The reason I put, and I'll discuss some of these because some of these are very, very self-explanatory, like valuations, corporate governance are quite self-explanatory, but families giving up control. The reason I've put that more particularly is because in India, as you know, most of the businesses are kind of governed by family houses. That's been the traditional concept. We've also seen, the head of the family, the patriarch, who's kind of the chairman. Then the one son or daughter takes care of sales, another one takes care of finance, and that's been the history of how these business houses have developed so far. But having said that, I think what is also important for all of us to recognize is the fact that when you go down that path, then you got to recognize that if you have to get in an investor, then you also need to ensure that your decision making somewhere has to get diluted to some extent, or you may say explode with the help of further kind of fresh minds joining the board, depending on the situation. So, families giving up control to an extent plays a very important role, more particularly in the Indian setup. Cultural differences, again, not necessarily what I mean is just different types of working. It also means the various cross-country, cross-border kind of a situation. I'll give you one example, friends. I was working on a transaction where a UK company was looking to acquire an Indian conglomerate. The Indian conglomerate was again owned by a family. But the Indian mother company, which is the main company where the shares were being planned, was kind of a listed entity, and it had about 60 subsidiaries in India because the nature of the business required every company to be in a particular state or a company to look at a particular part of the business. So 60 subsidiaries in India, and they had about 30 subsidiaries outside of India because the business was large. So the acquisition only happened at the mother company level, but it would ultimately take into account the value of all of these 60 and the 30, 90 entities put together. Now, from a financial point of view, it perhaps may be a bit more straightforward because you have financial consolidation, you have accounts get consolidated, at the parent level. So if one were to look at the financial statements, you will have consolidated financial statements that will give you the profit and loss account, the EBITDA at the group at the console level. But from a tax point of view, I'll just give you a quick flavor. Every entity has to file a separate tax return. And when you file a separate tax return, you have an audit, the assessment that happens in India. Now, typically that takes about a year. Now, if the tax authorities are kind of, okay with the fundamentals, then they would go ahead and kind of accept the return. If they have a grievance, then an appeal can be filed. An appeal filed can go into litigation. So for one particular company, for one particular year, I think all of us know that there could be 3 or 4 appeals. One could be against the tax, a revision petition, against the computation. There could be a rectification application. There could also be appeal against penalty, etc., for 1 year. And by the way, the company that I was referring to is almost 40 years of age. So to a great extent, every year filing one single tax return, and then for 40 years, all of that coming into play. Now, that's not the end of the complication. It had 30 entities outside of India, which meant that entities which are in Europe for filing a return, entities in the US for filing a tax return, all that also needs to be considered because if there is a contingent liability, if there is a unknown liability, then that needs to be factored in the valuation that you would typically do as part of the conversation. So to carry out a review, the point I'm trying to make is the carrying out the review of the tax profile and litigation of the entities can really be complicated. It is certainly complex. It certainly requires a fair amount of kind of understanding of the laws of various countries. And more importantly, the beauty of everything is to do this review, there is no substantial time available. So typically, a due diligence, as it is called, is expected to last 4 to 6 weeks, and you got to do all of this stuff in 4 to 6 weeks. Not just a review, coming up with a conclusion. Conclusion means answering 3 golden questions. First, is the price that being discussed further to be changed, negotiated, adjusted, if there are any large red flags? If so, are these red flags material or are these not material? And third, how do you deal with it? Do you adjust the price, or do you look at indemnities, or there is also insurance that is pretty much common these days. So these are the three golden questions that are expected to be answered when you're dealing with the situation. And in a due diligence, as I said, 4 to 6 weeks, you want to come up with all of this. So there really needs to be sharp pair of eyes that look at a transaction. So that's to give you a flavor of the complication of a particular transaction. So as you look at the whole life cycle of the deal, you start with the deal selection. You then get to the due diligence phase, which is what I was mentioning. You then get to the structuring phase, which is where you're looking at all of those items, those exposures, what is the funding available, how are you going to deal with the structures, and how are you going to ensure that for the acquirer, which could be a private equity investor or a corporate investor, how these need to be factored in. So as I explained to you, whether you look at the indemnity standard protection, or you look at something more, which is adjustment to the price or an insurance. So all of that comes into play. Thereafter, you have negotiations, because all these are tools for negotiation, and then the integration takes place, and then you're kind of ensuring that you're moving forward. Any acquisition has exactly this kind of a situation. So I do see one question from Devakar. It reads, can we get insurance for even the identified issues during the DD, or only for unidentified, unknown ones? Fabulous question, Devakar. Let me explain to you. The answer to the question is yes. You can get insurance even for issues which are identified during the DD. In fact, an insurance is like any other insurance policy. The parties, the deal makers decide as to what should be the sum assured, and the premium, etc., is decided accordingly. Now, the sum assured is what is sum assured? Sum assured in this context is the aggregation of the potential tax exposure that could come to the company. Now, when will you have a good handle of the sum assured? You would have a good handle of the sum assured when things are coming out of the DD. Because if it's an unknown, then it will always remain an unknown, and you'll keep putting a buffer, but you will not have a handle of what the amount is. So the sum assured is nothing but a derivation of the aggregation of all of these kind of bits and pieces of, in some form or fashion, the exposures which are coming out of the review of the DD. And then you're kind of aggregating all of that together to ensure that, this is a kind of a big success. So my limited point is that as part of the DD, and I hope I've answered your question, Devakar, you would have issues that will come out, but because there is a lag, and what I mean by the lag is once a tax return is filed, by the time issues with the tax authority surface, it can take at least 12 to 18 months. So within 18 months, you really don't know what the issues are going to be, what the quantification is going to be from a tax department point of view. By the time of 18 months, you would have already filed one more tax return, because every 12 months is where you need to file a tax return, right? So there's one more return pending to be kind of reviewed. So that period where the tax authorities have not reacted because they still have time to react is kind of the blackout period. It's a black hole where you don't know as a buyer, and you can't wait for the tax authorities to even kind of give the verdict, because they take the time given as per law for them to come up with the assessment. So having said all of that, what typically happens is, for the period the audit has happened, the quantification, etc., takes place. For the period subsequent to that audit, which is the blackout period, there is an assessment to be made as to what could be potential exposures that could come into the future. And on that basis, one can then thereafter kind of get to a situation where you're kind of bottoming it out to say, okay, these could be potential additional exposures. Now, the three things that, as I mentioned, high risk, medium risk, low risk, what's the materiality, and what is the way to solve it. Now, one of the important aspects that comes in is this an industry issue, or is this an issue pertaining to this very company? So I'll give you an example. there is a very standard issue on the GST exposure on gifts and samples with a TDS provision on the gifts and samples. So this industry issue, frankly, is is prevalent in the consumer and in the healthcare sector, and hence, when you look at this kind of a situation, then you come up with a conclusion that look, between this, it's a standard issue. Everybody in the market is facing that, and hence, it's not something applicable only to the company. But there are some other issues. For example, a company comes up with a VRS and claims a huge amount of expenses. A company is, say, for example, liable to pay some compensation on account of some litigation. As a result of that, a big debit hits the P&L. And then those could be in the blackout period. So that's very specific to the company. As an advisor, you are expected to know what's the view on those as well. So that is the culmination of the due diligence and getting into the negotiation. Khyati has raised a question: practically, what is preferred in deals? Insurance, escrow, indemnities. How is it practically decided in deals as per today's market situation for quantified high risk exposures? There would be price adjustments apart from that. Right. No, good question again, Khyati. See, insurance typically is available where the risk is not high, because insurance companies don't want to kind of underwrite high risk items. Where is it a high risk and the amount is material, then generally the tendency is moving towards either a price adjustment or a specific indemnity, because a specific indemnity will be only exclusively dedicated for tax and for that particular line item, rather than a general indemnity. Indemnity is generally given in all cases, except in situations where the private equity fund really would not be preferring to give, because their policies don't permit, or the fund life could be shorter than the tax kind of statute of limitation. So in that case, indemnities are generally not given in those cases. However, having said that, I think what is also important is all the three avenues: price adjustment, indemnity, insurance, are put on the table for discussion. And then depending on how the negotiations go, each one of them is pulled. Indemnity is generally kept unless there is a complete non-starter. If it goes to insurance, then you don't need an indemnity in that sense, because then you're pretty much covered. The insurance also is an expensive mode, I must say. Escrow is also an expensive mode, not very, very popular from that perspective, but it all depends on what are the levels of risk quantification and what's the view in terms of seriousness of the risk. So I hope I've answered that as well, Khyati. So moving ahead, the types of deals. I think you've heard about this. You have two types of deals broadly, and I'm keeping this very, very simple, because things can be very complicated when you look at structure and tax. The one type of deal is a stock deal, where you're simply having a buyer acquiring shares of the company. The example I gave you of this UK company was a stock deal, where shares of the Indian company were purchased, which was the parent company of the 90 odd subsidiaries, 60 in India, 30 outside of India. The other type of deal is an asset deal. Now, what happens in an asset deal? In an asset deal, it is an acquisition of a business. So you may have heard about the concept of slump sale. You may have also heard asset sale. So you're buying the business. So that's the other way of kind of doing acquisitions. We've seen both. Again, it depends. And I will touch upon this in the next few minutes as to who prefers what, the buyer or the seller. But this is to give you a flavor of how things can be structured. Now, when you're carrying out any due diligence, I think what is also important, which I perhaps could have mentioned when I was giving the example of 60 and 30 entities, you may have these entities standalone basis in the past. You may have these entities arising as a result of restructuring. So there could be an entity which could have merged into one of those 60 entities, in which case you'll have to go back in time to see the predecessor entity, what are the exposures and tax litigation of the predecessor entity for you to come to that conclusion. So the risk of litigation is generally there. The litigation risk can be broken up into two parts. One is a historical risk. where you're looking at all the past risk and the black hole period, as I was explaining. Second is the risk on the transaction. Now, what do you mean by risk on the transaction? Uh, if you have a seller of the shares in this example, say the seller is a non-resident from an Indian law perspective. Uh, if the seller is a non-resident, then the buyer who's purchasing and paying the price has to withhold tax as per the Indian law. Now, the withholding of tax takes place on the basis of the capital gains the seller will earn. So I'll give you, I'll explain this a little differently. Seller is a non-resident selling shares of an Indian company. On that sale of shares, let's assume that the seller is liable to tax. Tax would be in the form of capital gains tax. Very simply put, sale minus the cost. But the seller had acquired this company in, say, US dollars many years ago. It is selling today. What is the requirement for the buyer? Buyer has no clue on what has been the cost. He doesn't care because that's the seller's problem, is what the buyer will feel. But that's not correct. The buyer is under an obligation to withhold tax on the capital gains that will arise in the hands of the seller, which effectively means that the buyer should get a good handle of what is the capital gains, what is the sale, what is the cost in the hands of the seller. That means the seller needs to represent proper details, give the capital gains computation, give various comforts to the buyer, or maybe even give a tax department's kind of authorization. And only on that basis, the buyer will go ahead and withhold the tax. If the buyer doesn't do that, or there is a shortfall, then the tax authorities can actually go behind the buyer for a shortfall of the withholding tax. So we may have seen and heard about the famous Vodafone controversy. Vodafone was the acquirer. We all know that. The tax department went behind Vodafone. They didn't go behind the seller so much. And the main reason why they went behind Vodafone was because Vodafone was under an obligation to withhold tax. And the tax department felt that maybe there was shortfall of withholding of tax. So the obligation is actually on the buyer and not necessarily on the seller, but it is with regard to the capital gains arising in the hands of the seller. That, I think, is an extremely important aspect of what I thought I'll mention. Kishore, you have a question which I will address. Will DTA be applicable for this foreign seller, which is the double tax avoidance agreement? I will touch upon that as we move forward. There is a slide on that as well. So this is the risk on the transaction itself. Now, it is not the past, it's not the future, it's on the deal itself if there is a shortfall in withholding. So that is, I think, what from a protection point of view, one has to keep in mind. Now, there are the deal discussions that happen in every deal. You have certain deal breakers, large differences of views. For example, the buyer says, look, I believe there is a big exposure because you've not paid this tax in the past, and I have an advice that you should have paid tax. The seller says, look, I don't think so, that's right, and different view has another advice. And then if the amount is very large, it becomes a deal breaker. But there could be certain other non-tax issues, there could be certain other areas, and that's where the negotiation starts. And you always have a give and take. And that's where you do a commercial override. So the way it typically works is you inventorize all the risks, you decide which are the issues that will be put in the agreement, which is the shareholder agreement or share purchase agreement or the business transfer agreement. And then you take a call as to which ones you would want to drop in the interest of commercial agreement and then kind of move forward. That's the general tendency of kind of moving ahead. Now, let me dwell a little bit more, and this is where I'll touch upon the various practical aspects of a private equity transaction or of how funding happens. Now, you may have seen about maybe once in every 2 days, you see a private equity investment into India or somebody is exiting. How does that really work? So I'm going to spend the next few minutes in walking you through with how does it actually really work in real life. Some of the examples I'm going to give you and share with you are real life situations. They may not have names, but believe me, these are live structures. Now, in a private equity fund, you have a fund. A fund is more like a partnership or like a vehicle where funds are pooled. And then you have various vehicles that pretty much kind of come in, where you could have borrowings, you could have entities in different jurisdictions depending on the commercial requirements, and thereafter an acquisition of the target takes place. So let's look at the types of borrowings. Borrowings could be either senior debt, could be a second lien, could be a mezzanine debt, could be securitization where you're pretty much securitizing assets, or in some asset deals that we saw, could be a sale and lease back. So these are ways and means of financing transactions in a very, very simplistic manner. Now, I don't know if you've heard about leveraged buyouts. Now, in a leveraged buyout, what happens is that an acquisition has happened, a company has bought shares. Let's go upwards for a minute. Take this example, and you will see the arrows. You will see there is a senior debt that has been taken at the bidco level. Now, the bidco is the company that belongs to the buyer. It acquires the target. Debt taken at bidco and some amount of money coming in from the actual fund from top. Now, when bidco does the acquisition, the target, let's assume over here, is a profitable target. When the target has to file a tax return, it will show the profits going forward, and on that profit, it will be liable to pay tax. The bidco, assuming there is no dividend which is flowing up, the bidco will only have a loss, which effectively is nothing but the debt taken at the bidco level, and that's what it will show, a loss, because the interest will be paid by the bidco. In fact, the bidco will have to be funded to pay the interest. Now, in some of the jurisdictions, not in India, but in Europe and US, you have the concept of tax consolidation, which effectively means that taxpayers can choose to file one tax return for the consolidated entity. So in this case, if the taxpayer chooses a one return in that country, assuming this target is not in India, then bidco and target will file one tax return. What does that effectively mean? It effectively means that you're going to offset the interest against the profits that the target makes. So that means there's less amount of tax that you will have to pay, because the law of that country allows you to kind of consolidate. In the Indian context, that's not possible. And that's what a leveraged buyout is. In Indian concept, there's no tax consolidation. You can't file one tax return for both the entities. And that's where you have pay tax on your target, show a loss in the bidco, and that's what people would then land up concluding. So that is what one kind of looks at when one looks at an LBO situation. The other important difference or kind of comparison that I always make is amortization of goodwill. Now, in the Indian law, Indian tax law more particularly, goodwill can't be depreciated for tax purposes. Whereas some of the countries provide for tax depreciation on goodwill, on kind of intangibles as well. In India, you only have for intangible assets as defined, but goodwill is not, but some countries do have. So that's another kind of a variation between what the Indian tax law provides and what the overseas tax law provides. Share swaps. Now, what is a share swap? In very simple terms, as the term indicates, it's exchanging one share with the other. In India, exchange is clearly a taxable event unless it is done under a merger, and hence there's no kind of exemption. In some countries, more particularly in the overseas market, in the US and the UK actually, there is exemption given, or could be a kind of a deferment in some form or fashion to the share swap. So what some of the laws say that when the shares are exchanged, at that point of time, no tax unless and until they are kind of sold. So laws again are different there, and one needs to be very, very mindful, specifically when you're dealing with, kind of overseas cross-border kind of a situation. I'll skip the later one because I have covered that in a different perspective. So what are we reflecting on? We're reflecting on, is there effective relief for the interest expenditure? Is there a need to match interest versus the profits? You've got to consider the implications of having debt versus equity, because debt gives rise to interest, equity to dividend, but dividend is more discretionary. And also consider various regulation, governance requirements, consider the fact that what are the business commercial considerations before a decision is taken on how to structure an acquisition. So having seen all of this, I'm going to spend some time on this slide. This is a practical structure of a private equity fund, and this is where I'll come up with the treaty point that was raised by Kishore. So you see a top level of entities. You'll see all of these kind of pension funds. They are the limited partners. A limited partner is like a partner in a partnership, but like a sleeping partner, contributing to capital, not very much concerned, expecting a return on the contribution. So who does the running around? Why do you see all these private equity guys, running around all over the place? The running around is done by the GP, which is the general partner. So the general partner provides the capital in the form of intellectual capabilities, the technicalities. The money comes in largely from the limited partners. That's how a partnership firm, funds are pooled. You see the private equity house, and then investment is made, say, in portfolio company in India. Now, in this example, you see Mauritius between the fund and India. The reason is that there are tax treaties that India has signed which override the income tax law, whereby there are exemptions available. Now, most of these are historical. They are no longer available today. But let me explain to you what that exemption is. If a Mauritius company were to sell the shares of the Indian company, in my example, non-resident selling shares of the Indian company, as we spoke, there would be capital gains. But there was a treaty that India had with Mauritius, whereby it was said that there will not be any tax on this kind of a sale in India, because there was a kind of an economic cooperation agreement signed between India and the government of Mauritius. Now, this was a bone of contention. In fact, this is one of the reasons why when you look at FDI in India, largely you will see Mauritius and Singapore pretty much top of the charts. Obviously, the money is not getting originated in Mauritius. It's getting pooled or getting sourced, but the origin of it could be in other parts of the world in many cases. So Mauritius companies selling shares of India, you save capital gains tax. And that is where we were trying to get to treaties. But more often than not, I think the Indian authorities also realized that perhaps it was time for things to change in the new world order, and hence there was a grandfathering which was put into place. Today, as the law stands, any sale that is happening for Mauritius companies selling into India, if these shares were acquired before 2017, only then there would be the benefit of the treaty available. Otherwise, no benefit of the treaty available. So new shares acquired after 17, no benefit available for Mauritius, for Cyprus, for Singapore, because all the three treaties were amended and pretty much the law is now settled to that extent. So that is why people now don't go to Mauritius. They still go to Singapore because many of those funds take Singapore as an Asia Pacific hub. Singapore has a fund regime which becomes very lucrative for them, and that helps them to make these investments downstream. So that's the context of the double tax agreement. That's the context of the private equity structure. Now, what does the LP get and what does the GP get? Investments are made. You see a lot more dotted lines, and I'll explain that in a minute. The returns come as a result, not so much as dividend, but exits. When exits are made, there's a gain on the exit. And that gain is then distributed to the LPs and the GPs and the people who contribute to the success. How is that distribution happening? Let me explain that with the help of an example, which is there. Just one second. Yeah. So the distribution typically happens by virtue of carried interest. Now, carried interest is nothing but the effort or the return of the effort that is put in by the GP and the LP. And that's where you see the fund advisory fees, the deal fees, and the carried interest. Now, one final point before I move ahead, the right side of the structure is very important. This is the investment advisory vertical. So the offices that you see in India are literally the investment advisory company of the private equity house, which is sitting globally. So the right bottom box is where the Indian entity is, and they pretty much advise the fund of what they should be investing, what sector, which company, and then help the fund to take a decision or recommend to the fund various advice that they may want to they may have on a particular transaction, and then the fund then takes a decision. For performing that advisory work, these guys get investment advisory or deal advisory fees, and that pretty much is a cost plus kind of a model that exists today. So this is how the private equity model works. Now, keeping all of this in mind, one particular aspect I'd like to mention, which again was introduced under the Indian law, which was the general anti-avoidance regulations. A very healthy law, a very healthy provision to say that if there is any step undertaken with a view to avoid tax, that would be captured under GAR, and the authorities can disregard kind of form over substance, and then pierce the wheel and kind of tax entities. That was the power given to the authorities. Okay, so having said that, I'm going to quickly move towards one aspect, which is some of these nuances, and then we'll quickly get to some more question answers. I've got some case studies, and I want to share that with you. Now, a direct transfer is, if you see over here, B Limited selling shares of C Limited. Very simple. We explained the Mauritius example. I explained to you capital gains, withholding tax. The indirect transfer is the same type of transaction, but A selling B shares. This was the exact Vodafone case. What happened in the case of Vodafone is a foreign company's shares were sold by a foreign company to a foreign company in a foreign country. But the value of those shares was derived from India. And that's why the Indian tax authorities put up the claim that they should be taxable in India. Now, obviously, the Supreme Court, because the law, the way it was drafted, the Supreme Court decided in favor of Vodafone. But today, as the law stands, all that is history. As the law stands, it says that the value in this kind of a transaction, a global deal happening, India is part of it. If India is contributing to more than 50% of the value, then there is tax to be paid in India. That's the period law that exists today. So I thought I'll just mention that to you. It's important that you know under what circumstances tax should be triggered. There are also filing requirements, and there are rules to determine that 50% threshold also. Okay, so I think I'll skip this. I will directly go into inbound and outbound kind of structures. Now, debt push down typically is not very much common in India, because as I was explaining to you, every entity has to file a separate tax return. So in a bidco target kind of model, you have interest expense and you have profit sitting, and then you can't combine the two. But in a case where you have profitable business sitting into a target entity, and you're taking that business and you already have borrowings, everything then sits in the new co in this example, then the interest expense can be offset against the profits because it's all sitting in one single entity and for the purposes of business. So that, I think, is an important aspect and a nuance. But remember one thing, a slump sale would mean the consideration will go to the target entity. It won't go to the shareholders. Whereas a share sale, the consideration will go to the shareholders. That's a big difference, because for those selling shareholders, if they need to pull out the cash from the target, they will have to pay additional tax, which could be a way of dividends or capital reduction or otherwise. But all these are taxable modes. That's the big difference between the slump sale and the share sale from a tax point of view. All right, so now let's get into real action. This is to give you a perspective that the Indian tax law kind of refers to various provisions. I spoke about asset sale, stock sale, slump sale, itemized sale. There are sections that talk about all of this. And now let's get to this part of it, which is where I want to spend about 5 or 10 minutes to kind of get your views. So what I'm going to do now, friends, is I have a few slides which have some questions. I'd like you to react. Again, use your chat box. What is your view? And believe me, these are all practical examples that I've come across in my limited experience that I've had. So Let's start with the first case study. So you look at this as a structure. You have a company, you have a US company, very simple, common structure. Now, for whatever reasons, there is a plan or a proposal, business reasons, commercial reasons largely, that they would like to have this entity merge up into US1 merging into USCO. And as a result of this, the resultant structure will be very simple this way. The question that I have for all of you guys, the overseas entities will be by virtue of a merger. Is this a taxable event? That is where I'd like to get your thoughts. Okay, I'm already seeing some people saying no, some people saying yes. Khyati is saying indirect transfer. Okay. So if it's an indirect transfer, it's not a transfer as such, it's a merger. Does that help? Just pause here for a second before I move forward. Okay, so yes, it is an indirect transfer. You're spot on. I think what is also important is that merger, there is an exemption that is available under indirect transfer under specific circumstances. Otherwise, it is a taxable event. Fabulous. I'm super excited to see the participation of all of you friends. Let's move ahead. All right, so let me see whether you get this one right as well. Again, a very common situation. You have this, and this is going to be the post-merger situation. Is this taxable? Is this not taxable in India? There's no indirect transfer here, just to clarify. Tell me, what do you think? Any thoughts on this one? Okay. Okay, I'm seeing people saying taxable, but I also saw a non-taxable event. All right, the answer to this is, I think Khyati is right. This is not taxable because there is a specific provision in the Indian tax law which gives exemption to this kind of a merger. All right, so what about this? A collapse of Mauritius into India. Taxable, non-taxable. Again, a very common kind of a case study. All right, good. So I think most of you have got this right. This is an inbound merger under the NCLT, under Section 21B of the Income Tax Act. This would not be taxable. And a lot of companies have done that because, as I was explaining, when Mauritius, Cyprus, Singapore routes were kind of shut down, companies said, what's the point in having all these entities? Let's collapse them. All right, now this is more interesting. Let me see how many of you get this out. This is outbound now. When Indian companies are investing outside of India, there is a reasonable amount of relaxation available, good amount of amount that they can invest. There are reasonable provisions under FEMA, under income tax. So if you were to keep into mind, there could also be, a step entities, intermediary holding companies for making investments in Europe, in Asia Pacific, in Americas. I mean, this is again a common structure. Let me hear what you feel the answer to this is. So Indian company on top, having two subsidiaries, they both merging. Taxable, non-taxable. We saw the reverse case a few minutes ago. Okay, I'm generally getting no. Okay, I'm getting yes now, taxable. Okay, so the answer is unfortunately, there is no provision in the income tax law which gives exemption. The reverse, there was a provision we spoke, but technically this would be taxable, but this needs to be structured in case, depending on the facts on how to do this the best way. Okay, what about this? Sorry. So again, an outbound merger into India. Again, this would not be taxable because, as we said, cross-border mergers outbound also are now allowed. So under NCLT, so it's a good way to repatriate cash into India and kind of be done with it. Okay, so debt pushdown is something that I explained to you. This is just you need not look at the text, look at the diagram. The two entities, the BidCo, the target, uh, filing a single tax return. I discussed that's how people have done, and it's allowed under the law. You opt for it. Obviously, you can't keep changing your options. You do it once, and then you got to be locked into that option. India doesn't have that, but from an outbound perspective, one can take advantage. A lot of IT companies headquartered in India, which have presence outside, file one return for one particular jurisdiction, provided that law of that country permits to opt for this selection. So that again is important. It also acts like a funding mechanism. It also reduces the effective tax rate to a great extent. So I thought I'll just mention that to you as an option of moving kind of forward. Okay, you're seeing a lot of IPOs these days. I just want to spend a couple of minutes on what's happening generally in the marketplace. So IPOs are now getting launched at the behest of financial investors, at the behest of promoters. But prior to launch of IPOs, there's a lot of activity that we are witnessing. Core, non-core segregation is the one activity. Second, getting the operations, the IT systems, the records, everything in order, the systems being absolutely tight and sharp to ensure that there are no loopholes. Third, most importantly, getting the MISs, the reporting, the governance put into place so that the track records and all are absolutely tight. And then getting perhaps a pre-IPO funding, if at all is needed, getting a private equity fund or a VC fund or a family office actually to fund a pre-IPO structure. And then once you launch the IPO, there could be exit mechanisms available for the financial investor. So all of that requires some part of the structuring, as I was speaking, some part of the indemnity calculation, some part of merger, demerger, and kind of working in that direction. Okay, so these are some of the nuances that one has to keep in mind. I think I touched upon most of it. What I wanted to do was spend some time on this aspect, the SPACs. Now, SPACs is something that we did see. We saw some of the Indian companies kind of getting listed outside of India. So the reverse case, although currently the trend appears to be more listing into India. But what is a SPAC? How does it work? I'll explain to you only with the help of this one diagram. So if you look at on the left side, you got an Indian opco, you got owners, you got financial investors, and then you got a SPAC, which is a foreign listed kind of a blank check company, as it's called. Now, when you do a restructuring steps, the right side is where you land up into your destination structure. The moment you do that, if you see the opco has come below a new holdco, which is now having their foreign investors in it. Now, this could be listed outside by way of issuance of instruments, but the value of that is now being captured from the Indian business. This is how you have the special purpose acquisition companies, the SPAC in this case, which is the light kind of yellowish green, come into play. So getting a company in India or getting business in India to be listed outside of India, or getting a foreign company to be listed in India, both sides are possible. Currently, it's the reverse, which is foreign companies coming here, doing a reverse flip, which again we've seen in some cases, and IPOs thereafter, or keeping a SPAC and trying to see if you want to consider that. This is currently not very popular, only because of how the capital markets are behaving. But I thought I'll just park this point with you, since it does require a reasonable amount of structuring nuance and the tax attributes to this. Okay, so I want to spend the last a few minutes on talking about Section 281, which again is a very important section. So this is a section that exists in the income tax law. What does the section say, and what is the practical nuance of the section? This section says that when you have a shareholder or an owner of an asset selling an asset in India, obviously there is capital gains, etc., to be paid. That's fine. But if that seller, the selling shareholder, has a huge amount of tax liability for other reasons, uh, the requirement today is that the buyer has to insist that a no objection certificate or a letter for the sale of the shares is obtained by the seller from the tax authorities. So Section 281 clearance, as it's called, says that before a transaction is consummated, the seller should get a letter from the tax department that they have no objection in selling the shares to this buyer. The reason why it is required from a tax department's point of view is, let's assume there's a huge amount of tax demand the seller has. The only security the tax department has are the assets which are owned by the seller. When the assets are sold, at that point of time, the seller gets money. Now, if there was no requirement for 281, he could sell the assets, distribute the money to the shareholders, and tell the tax department, look, I have nothing to give, I've already distributed. In order to protect the interest of the revenue, there is a requirement that the tax department has to give a clearance before the seller gives the sale. And if he does not go for clearance, the downside is the tax department can consider this transfer to be void, which means the buyer has paid the price, got the shares, and now the seller says, look, I'm taking away the shares without paying you anything. So it's a double whammy for the buyer. And hence the buyer has to be extra careful to ensure that there is a 281 clearance available or comfort available to ensure that this will not happen in this particular case. Khyati has raised a question. Yes, there is a section which is called Section 81 under the GST law, which also requires a similar kind of approval. Now, practically what happens is that the sellers, if they decide, and the buyer and seller sit together and decide commercially, they may not really want to approach the tax department because it may take more time, they may not have the time. It's purely commercially driven. It's nothing to do. The tax law remains. There is no exemption given. But what we have seen in practical terms is making an independent assessment as to what is the tax liabilities outstanding. Are there any big exposures that the selling shareholders is exposed to? If not, then the transaction can go ahead, and the chances of this section being invoked, I think if the buyer is comfortable, then they move ahead. That's the practical side of it. So Section 281 and Section 81 clearance under the GST law and income tax law are the ones that are very, very common. This is applicable for all types of assets that are in India. Largely, there's a definition, but largely applicable for all types of assets that are prevailing in India. So I think this was, I thought, a very important associated. The question that Abhishek has asked, can the risk under Section 281 be covered by insurance? See, 281, first of all, is with regard to the seller. It's a good question. It's not with regard to the company which is being sold. Normally, you would get the insurance with regard to the company. In my experience, the selling shareholders don't normally resort to insurance because the selling shareholder may have lots of other, tax attributes, and nobody's done diligence on the sellers. Remember, we've done diligence on the company. So there's a difference between the two. And normally, the insurance guys would not venture into it if the risk is high. The way it is normally resolved is comfort given by the seller to the buyer to ensure that they have enough net worth or security or less of liabilities. That, I think, and an independent review of that kind of is the way that generally things are resolved in this particular area. Okay, I know there was a lot to cover, but there are certain other provisions. For example, I wanted to touch upon Section 56 to 10. Maybe I'll spend half a minute. 56 to 10 is a section whereby if there are transfers of any assets, and if these are for inadequate consideration, hence the buyer can be liable to tax to the extent of the difference in the value and the actual consideration. So if an asset is valued at 100 and there's a specific method to value, and I transfer at 80 to a buyer, the 20 the buyer would be taxed as a deemed consideration. So that I think is another important aspect of this. So I see a couple of questions. I'll just read out. What are some of the practical challenges for the buyer and the seller for sale of a company via a slum sale? Well, generally, from a seller's point of view, they'll prefer an asset sale. They won't prefer a slum sale, as I was explaining. In the case of the buyer, he would prefer a slum sale because he can buy the asset, value those assets in their books, and also claim depreciation to the extent of the value ascribed. Risk associated, I think, with regard to slum sale, is a slum sale is a taxable transaction, so is a share sale. There is no difference there. But uh, a slum sale would also mean what is being sold. Is it a business? What is being left in the company which is selling? Is there some activity left? All those are nuances that needs to be considered. You can't simply pick and choose the most favorable method. I see another question: how to structure a deal where the buyer is interested to buy despite the company having made contingent liabilities in terms of non-compliances? Well, one has to analyze what is the level of the contingent liability non-compliance, what is the materiality, and is it an industry issue, as I was explaining, Shilpa, and then that's the best way to kind of take a practical call, and then you already have insurance and kind of indemnity to kind of look at. Okay, friends, any other questions? I have taken 5 minutes more. Apologies for that. But any questions that any one of you have, I'll be more than happy to answer. Or if there are, any kind of thought or any suggestions, please let me know. We're very, very keen to kind of I'm really, really happy and glad to see, I think, the way we've you guys have reacted to some of these points. I hope you found this to be interesting. There was a lot to cover, very complex topic, but I tried my best to keep this very succinct and kind of simple from my side. I'll just pause it if there are any questions.
Second your thoughts, Anil. I absolutely second your thoughts here. Quite an engaging session that we have had so far during the day. Divakar, I will just give you the option to unmute yourself so that you can speak to Anil. Give me a minute.
Yeah,
Yeah.
hi Anil. Thanks for the session. So on the insurance part, I just wanted to check with you. So let's say there's a deal as a buyer which I'm evaluating, and there are labor compliance issues in the sellers during the seller's DD, and we don't know. We know we can quantify some part, but we don't know what else will come out. So let's say there were some employees to which overtime or PFESI was not paid, and we don't know how many of them will come back. Some have left the organization, some are not traceable. So will I can I get insurance on that part, even if it is identified during the DD? And can I get insurance on tax parts also, like GST and all indirect taxes?
Well, if the risk is high, then generally, as I was mentioning, the insurance companies don't entertain because either the premium becomes too much or it becomes difficult for them to even justify it. But if the risk is not high, then certainly there is a possibility this can be explored.
Okay. And secondly, on the withholding tax, so many of the times we see that the seller is the ultimate seller is a private equity company, and they are the holding company is based out of India. So in that case, I mean, what I have seen, usually private equities are not that ready to to withhold tax. I mean, if I am the buyer, I'm withholding tax, they will resist. So, can I get insurance in that also, or is it challenging?
The law requires that if the seller is a non-resident, the buyer is required to withhold tax. So there is no substitute for that. Now,
Okay.
if you are withholding an amount that you believe is the right amount, and you need comfort that the cost of acquisition or the sale or any other computation mechanism, you're not very clear, then it's an interpretation issue that you can look at, but you can't simply absolve the law and substitute the law by insurance.
Okay. Okay. Thank you.
I do see a question on the chat by Divya. In what cases the seller would prefer a slump sale rather than a share sale? Well, if the seller's entity in India has got multiple businesses, say real estate, etc., and he is not wanting to sell those, then that's one of the cases that he may prefer to slump sale the other businesses, because then moving
Anil, you weren't audible in between. I think your
around
voice
entities.
just faded. Yeah.
Oh, okay. Is it audible now?
Yeah, it is. It is, yeah.
So I'll just repeat what I said is the seller would prefer a slump sale where the entity that he's selling has got other businesses, including real estate, becomes difficult to move those. So that's where he would typically prefer a slump sale. And what I was saying is the buyer would also prefer a slump sale because, as I was saying, he can revalue the assets and claim depreciation.
All right, I think we don't have any more questions here. We can quickly sort of close the session also. Anil, thank you so much. I think the kind of engagement that we drove and we saw during the session was commendable. Any concluding remarks that you would want to end the session with?
Well, look, as I said, thank you very much for your time, and it's complex. Try to walk you through with some funding mechanisms, some deal nuances, some case studies. I try to keep it practical. But if there are any other follow-up questions, please reach out to me. I'm very happy to kind of answer.
All right, while we wait for this, guys, we will give you two more poll questions to just end the day on a good note and your feedback with. So just quickly send us your responses to, before we end the session for today. And with this, we are also wrapping up day one of our training. We will be back with our second day of training tomorrow, where we talk about high impact learning days on value creation, governance, exist, and strategic deal making. Everybody, just drop in your feedback in the poll, and thank you for engaging with our speakers and trainers so well and asking your questions and your doubts. Thank you for your active participation. Anil, thank you so much once again for facilitating this for our audience today.
Thank you very much, and have a good one.
Thank you.
Bye.
There, can we quickly have the other two questions also pulled in? Guys, before all of you log off, please ensure that you give us your feedback here. It's very critical for us to, come up with sessions that will be useful for you and for your learning. So please do ensure that you give us your feedback. It's very important for us. Also, we would like to know the topics that you would want us to cover. So please ensure that you share even at least the names of the topics that you would want us to curate a training on, and it's going to be useful for you. So thank you. Thank you for your feedbacks also here. Just help us with what's the kind of topic that you would want our trainings to be, planned in the near future. We shall look on those topics and then come up in the next quarter, and the next month that we have the time in our hands. So thank you so much once again, and we shall see you tomorrow on the day two of the training. Thank you. There, we're good to close. You can close it now. We shall run this tomorrow. Thank you.